The economy's in a pretty precarious place, but we're starting from a really strong base.
We need to be ready for some chaos along the way.
If we're in it for the long haul, then we have to accept the fact there will be implications to the economy.
We regard it as 45% chance of a recession in the US over this next year. And that's because of all this volatility and all this uncertainty.
This is a really highly uncertain time. This is an uncertain journey to an uncertain destination.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your trading week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday with Fed independence under siege.
On Jerome Powell, you said that the termination of Jerome Powell cannot come fast enough. He says he won't leave even if you ask him to.
Oh, he'll leave. If I ask him to, he'll be out of there. He's too late, always too late, a little slow, and I'm not happy with him. If I want him out, he'll be out of there real fast, believe me.
President Trump putting the pressure on Fed Chair Jay Powell and his economic advisors on pushing back.
And the obvious runaway spending from Joe Biden was textbook inflationary, and we didn't see anybody warning about that. And then they cut rates right ahead of the election. And so if you think that it's unacceptable for President Trump to be frustrated with the policy history of the Fed, then I think that you got some explaining to do.
So, is removing Powell an option? The president's top economist saying the president and his team will continue to study that. The public feud is hitting the US dollar weaker against every single G10 currency so far this morning, reinforcing the message from the Treasury Secretary, who has reportedly cautioned that firing Powell would destabilize markets. And according to the New York Times, the president is, for the moment at least, persuaded by that argument. The key words there, for the moment.
And that's the reason why people are trying to get ahead of that and maybe diversify away from dollar assets. You're seeing this pretty much across the board. Here's the key question. You can make whatever argument you want. Is this president willing to roil markets at a time where the likes of Chicago Fed President Austin Goolsbee over the weekend came out and said that countries that lost their Fed independence, their central bank independence, were challenged by a higher inflation rate, slower growth, and a worse job market?
This feels like a fluid conversation within the White House right now. It was just a week ago when I sat down with the Treasury Secretary Scott Bessent, and he said to me that monetary policy is a jewel box that needs to be preserved. Then, just 5 days later, we hear from Kevin Hassett saying that this remains an option, basically keeping the door open to conversations that are going on behind the scene, and him saying that they're looking at the legal avenues available to this president.
There's another Kevin in the mix here. Some fantastic reporting over the weekend. The Wall Street Journal indicating that even Powell's possible replacement, the former Fed Governor Kevin Walsh, has advised the president against firing Fed Chair Jay Powell. So the pushback coming from all corners.
And it even is coming from some Republican Congress members who went on the shows over the weekend to say this is probably not the greatest idea. Look, there needs to be at least a perception of Fed independence. And what happened to Scott Bessent's discussion with you, saying that, yeah, they're going to start interviewing later this year. They're not even thinking about it at a time when it seems like they're meeting every week to have lunch. I mean, come on, how much can they really hit each other?
Exactly, breakfast. And Bessent said last week it was an away game. He was at the Fed. This week he's going to be at Treasury because they meet every week for breakfast. I imagine this week is going to be a very interesting breakfast between Jay Powell and Scott Bessent. I was also struck by Kevin Hassett. In 2021, he wrote about in his book that the Fed independence needs to be preserved. The impact it could have on financial markets, the dollar, would be very terrible, according to Kevin Hassett in 2021. Now he's saying maybe his thinking has changed.
We'll see if breakfast gets cancelled. Equity futures on the S&P 500 negative here by 1 full percentage point. Coming up this hour, we'll catch up with Marvin Lower State Street following the S&P 500 seventh down week in 9. Terry Haines of Pangaea Policy on why Chair Powell's not going anywhere. And Jeremy Jansen on Wells Fargo on the impact of tariffs on supply chains. We begin this out with rising concerns over the Federal Reserve's independence. Marvin Lower State Street writing, it's reasonable that stocks can remain in a range for the moment. Incoming information will guide us if we need another leg down from a valuation perspective. Marvin joins us now for more. Marvin, we have some incoming information. Threats to Federal Reserve independence. What would happen if the president fired the chairman of the Federal Reserve?
I mean, ultimately, we're already starting to see the tremors of that discussion make its way through the market. Every day, it seems there are more and more reasons to really pare back, if you will, what's been an overweight position across U.S. assets. This just adds to another one of those walls of worry. I think longer term, one of the keys to the U.S. financial market is the independence of the Fed and their ability to operate the way they see the world's biggest economy needs to operate. And you really are on very shaky ground if you go down that route.
Marvin, we're discussing the optics of all of this. The legal constraints are another issue. And then the operational independence. If you look at the Federal Reserve, away from just the Federal Reserve chair, it takes more than just one man to make a move of that institution. Do you have any confidence in that at all?
You know what? I do. I mean, the Federal Reserve Act is a wonderful structure, one that was based on the fact that the country didn't really trust a broad monetary authority through a specific administration. The 2-year periods, the fact that the chair has to come from the existing board, I think all of those are brilliant approaches to it. But in going down this route, in terms of trying to replace the chair, the administration is looking to break down all of those really long-standing held strengths that have kept that institution isolated from the administration.
Mr. Market certainly has been having a bit of a difficult time recently, and seems like the anxiety levels are very high. And this morning, maybe they're accentuated by the fact that it's pretty thin liquidity. How much can you get a sense of what's noise from markets in terms of the magnitude of a shift away from U.S. assets, and what's actual signal about how much large asset allocation away from the United States is actually going on?
Yeah, Lisa, I mean, it is very, very hard. And, you know, the analyst community, myself included, we're always trying to curve fit and get an explanation of what some of these moves are doing. I do think that when we kind of look at how valuations have stabilized within a very, very volatile range over the course of the last week, it kind of shows that there was an adjustment period associated with it. But one of the takeaways that I have is around the dollar discussion that you led the hour off with. It is around how Treasury yields are responding to this. And these are the purest forms of expression of the U.S. economy. And, you know, I'm not comfortable just saying that we should ignore that because there's an adjustment associated with it going on.
And if you just look at the technicals, and the Treasury market hasn't yet opened because a lot of people are on vacation. We're not. But I know that London is on vacation and some other places as well for the Easter holiday. There is this question about that yield curve steepening and whether we could see that steepness at the highest levels going back to 2022 persist and extend. At what point would you come in and fade that versus just lean in and suggest that this is the path ahead?
So one of the things that I've been, you know, really, I guess, on a soapbox to a certain degree, and I've discussed it on your program, is the term premium that's kind of associated with the market, how much additional compensation one needs to go out the curve. I've targeted in the past somewhere in the range of 90 basis points, upwards of 120 basis points of term premium. Kind of based on certain measurements, we're at about 60, 65 basis points at this point, which is also a multi-year high. So I do think that there's a bit more pain. You know, I've talked about a 5% 10-year for a while, and that still seems like, you know, a thing to keep in one's mind, depending on how all of this evolves.
Marvin, however this evolves, the discussion is already out there, and it's going to be hard to put that genie back in the bottle. Is the discussion itself damaging enough for financial markets?
You know, it certainly is. We do need calmer heads to prevail within this discussion. And again, I'm reading the news that ultimately you folks are putting out there. It does seem that there are a lot of different voices within the administration that have a fairly significant seat at the table, which have opposing views. And we really need to get a sense of which one of those are louder and are guiding policy, whether it's around monetary policy, whether it's around the trade discussions, whether it's around deficit funding. All of that does come down, in my mind, into how the 10-year reacts to this. So, yeah, it's hard to put it back, but not all of the damage is completely irreversible at this point.
NEC Director Kevin Hassett, though, when he was asked about this and asked about his 2021 book, which he seems to be making a bit of a U-turn, he said, I think at that time the market was in a completely different place. Was the market in a different place that now would be acceptable to fire the Fed chair as opposed as it wasn't in Trump 1.0?
Yeah, thank you for that information, because actually I hadn't heard that before this morning. So that's a great data point. You know, a weakening of the dollar is one of the discussions that has emerged in terms of one of the goals of the administration. So certainly, you know, potentially somehow threading that reserve currency with a weaker dollar without giving up the ghost on the Treasury market, in my mind, is still something that we as investors have to watch in terms of a potential goal of the administration, because the Treasury market is at the center point of those, if you will, ideological approaches to how one would want to reorder global finance and global trade.
Hey, Marvin, appreciate your time and your input this morning. Thanks for catching up with us. Marvin Lowe there of State Street. If you're just joining us, some real dollar weakness across G10. A new low for the US dollar, new high for the euro, euro dollar 115.44. There is clearly some operational and institutional resilience of the Federal Reserve that we should probably talk about on a morning like this morning, but front and centre, just the slow decay of US assets over the year so far. The context here is really important. It's the timing of this conversation that counts. Only a few weeks ago, we were talking about the erosion of the safe haven status of US assets, and I think that weighs on that even more.
It just builds the narrative that already had been in place. And what you can see right now is diversification away from dollar-denominated assets. Japanese super long bonds just had their biggest inflow ever from foreign investors last month. You're seeing even emerging market bonds do better in local currencies than the U.S. dollar.
Dollar weaker. Equity sliding. We're down 1% on the S&P 500. With an update on stories elsewhere, let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hi, John. We begin with breaking news from earlier in the morning. Pope Francis has died at the age of 88. According to a statement from the Vatican, Francis passed away at 7:35 a.m. in Rome. He had been the spiritual leader of the world's nearly 1.5 billion Catholics since March of 2013. Francis hailed from Argentina, making him the first pope from the Americas, as well as the first Jesuit to hold the position. Elsewhere, the Trump administration considering a sweeping proposal that would reshape the State Department. The document says the changes to be made by October would eliminate dozens of positions and departments, including those dealing with climate, refugees, democracy, and Africa. In a post on X, Secretary of State Marco Rubio called the report fake news. And Tesla's planned rollout of its cheaper cars, including a lower-cost Model Y, has been delayed by at least 3 months. Reuters didn't cite a reason for the delay. Tesla is due to report earnings tomorrow. Investors looking for guidance on how it intends to turn around its shrinking market share. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny later on this hour. Up next on the programme, the Fed's credibility.
The only thing that's gone up, actually, is interest rates, because we have a Federal Reserve chairman that is playing politics. If I want him out, he'll be out of there real fast, believe me.
That conversation up next with Terry Haines of Pangaea Policy, live from New York City this morning. Good morning. Coming off the back of a weekly loss on the S&P 500, and the losses resume following the long weekend. Equity futures down by 1% on the S&P, and the Nasdaq 100 down by 1.1. In foreign exchange, more dollar weakness. DXY in the year so far, negative 9.5% and down 1 full percentage point on the session. Under surveillance this morning, the Fed's credibility.
The only thing that's gone up, actually, is interest rates, because we have a Federal Reserve chairman that is playing politics, somebody that I've never been very fond of, actually. But he's playing politics. Interest rates should be down now. If I want him out, he'll be out of there real fast, believe me.
So here's the latest this morning. Dollar weakness gaining momentum following President Trump's threats to fire Fed Chair Jay Powell. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, the pressure keeps building.
Yeah, hey, John, good morning. Particularly after NEC Chair Kevin Hassett on Friday suggested that the White House is seriously looking into potential pathways to remove Powell, saying that they will continue to study the issue. Now, Jerome Powell himself says he doesn't think President Trump has the legal authority to fire him and that he wouldn't step aside if asked to. And in theory, he's supposed to be shielded from being fired without cause by the Federal Reserve Act of 1913. But we're already starting to hear questions swirl about whether or not that would apply to removing him completely or potentially just removing him from the chairmanship. We should say there's a few legal battles brewing that we are watching very closely for their impacts here when it comes to any potential removals, including that this administration is asking the courts to weigh in on a legal precedent known as Humphrey's executor, which should shield federal independent regulators and agencies from being fired for political reasons. Now, that doesn't deal directly with the Federal Reserve, but is expected to potentially impact any future moves here. There's one case that is very likely to be decided by the Supreme Supreme Court. We don't have the exact timeline yet, but has to deal with a recent firing from a National Labor Relations Board member that could give us some clues into what this administration is looking for here when it comes to a legal pathway forward. John, we should say that ultimately we still don't have exact clarity on what President Trump meant when he said that the termination couldn't come fast enough, but you heard him double down on his criticism in the Oval Office as he tries to say that lower interest rates would offset his tariff policies.
Well, when it comes to his term ending, Tyler, we do know it's going to be May of next year. So who's on the short list right now that the president, the Treasury Secretary are thinking about potentially to fill that role?
Right. Well, we should get more clarity later this fall, as Treasury Secretary Scott Bessent told you that that's when that process is really starting to pick up here. We know that some other potential names that have been floated, including former Fed Governor Kevin Walsh, is on the short list, as well as we try to glean more information from the administration on exactly what they would like to see. There's already been some other positions that President Trump has floated some potential replacement for, including that Michelle Bowman is now up to be a Fed Vice Chair of Supervision after we saw her predecessor, Michael Barr, step down amid speculation that he would likely be removed or asked to be removed under this Trump administration. No doubt, though, it will take a Senate confirmation for whoever is confirmed, but with both chambers being controlled by Republicans, it's very likely that that will happen.
Tyler, appreciate the update. Tyler Kendall of Bloomberg down in Washington, D.C. Always interesting that Kevin Walsh's name is in the mix all the time when he's widely regarded as a hawk on Wall Street, but yet is still in the mix every single time this conversation comes up.
If you're trying to find economic logic behind this, good luck. And when you do figure it out, you can let us all know. Nonetheless, loyalty, I think, is number one. And the perception of loyalty seems to be front and center. A key question, though, what is the process going to look like, given the fact that Jerome Powell, if you remember, was a Trump nominee? So this is going to be a very difficult path ahead, both in understanding who would be selected, and what their policies would be.
To extend the conversation, Terry Haines of Pangaea Policy joins us now for more. Terry, welcome to the programme. A lot of bark here. How strong is the potential bite?
I think not that strong, John. Thanks. My summary of this really comes down to about three things. One is that Trump is trying to pass the buck to Powell for whatever market problems exist. Markets aren't going to bite on that, of course. They're very fixed on Trump. Secondly, you got a situation where, as you've been reporting, the Wall Street community is already reacting this time to the possibility of Powell's removal in a way that they haven't before. So that's a real concern. And finally, as Lisa mentioned earlier, you had the folks in Congress on the Sunday shows all basically providing a little bit of subtle pushback. So there's, I think there's at least three reasons why the bark is worse than the bite.
Terry, I'd love to get your thoughts, though, on what Kevin Hassett said, the NEC director, when he said that they're studying that option. He basically left the door open.
Well, I think he should, right? He's a lot of things, but fundamentally he's a staffer. And if he publicly dissents from whatever the president's doing, he's going to be out of there pretty quickly. So, I look at that as a matter of staff loyalty and not much else. They've been studying this since 2018 or 2019, by the way. So I welcome their continued study.
I want to get your thoughts. What I also asked Marvin Lowe, the fact that we're having this discussion out loud, the fact that the president didn't make clear what he said last week, which talking about his termination, is that enough to do damage?
To damage to Trump or to Powell?
To Trump, to the position, as well as to financial markets.
I think it doesn't help financial markets. I certainly don't think it helps the president. I mean, you can parse the statement that you all have been running in the bumpers, and if I want him out of there, he'll be out of there. Well, he's not out of there, and you don't like his policies, so. So he's staying. So you must like his policies. So there's that kind of circularity. And number one, and number two, the last thing that Trump needs right now is Wall Street fleeing on him when he's in the middle of the tariff fight. Firstly, and secondly, when tax cuts, which are still very, very likely at 80%, haven't come online yet.
It feels like President Trump is playing good cop, bad cop with markets right now. Bad cop, I don't know about Jerome Powell. Good cop, let's make a deal. All of a sudden, all of these deals potentially are on the table with Japan, with EU. And that's the upside that people are looking for. What if this actually leads to some sort of resolution? How much do you expect that to really take the brunt of oxygen this week?
Well, I think this week the White House would be smart to continue to bring out the prospect of deals being done, and I think they were reasonably effective at that the last couple of weeks, and that's all to the good. The better it is for what's best for the White House and what's best for the markets at this point are really the same thing, which are to see progress being made on the tariff deals and to clarify what I always think of as kind of the descent ascendant role here, which is that these things are supposed to be path dependent, and if we do deals, tariff rates, or tariff barriers and ex-tariff barriers come down for the United States and for others, benefiting markets. That's all good. By the time you get to next week, what you're going to see is more progress being made on tax cuts with the idea of a third quarter, fourth quarter deal. And, hopefully that helps them get through this patch.
Terry, should and will are two very different things. And it seems like you believe that markets do have some sort of, I don't want to say veto power, but certainly weight in the president's mind. What gives you that concrete sense, given the fact that there have been a number of occasions where President Trump has come out and pushed back against caring whatsoever about the move in the markets?
I think it's really this. I was one of the first, maybe the first, to say that I didn't think Trump cared about markets on tariffs with respect to imposing them. Tariffs, in my view, have always been part of a much broader economic plan that includes tax cuts and some other things. They've been, I think, very clear about that. But at the same time, it is not in the president's political interest at all to have markets go seriously wobbly on him at a time where he's trying to impose a lot of those things. So I think that market pressure actually helps define the situation a little bit better politically as well as economically.
Terry, you keep mentioning tax cuts. The market is pricing an extension of TCJA. What cuts are you talking about?
No, I'm talking about the extension of the 2017 cuts, and then you're going to see a bunch of tweaks to that, not just the taxes on tips thing that the president keeps talking about and other things. But I think you're also going to see a restructuring to really favor increased U.S. manufacturing and including reshoring, among other things.
Terry, appreciate your input as always, sir. Thanks for catching up with us this morning. Terry Haines there of Pangaea Policy. Neil Dutter of Renmark making the point several times over the last several months that the tax bill, in the way that he expects, is just removing a potential headwind as opposed to providing a potential tailwind.
Right, because basically what everyone is pricing in is current policy, an extension of Trump's first term. Cutting of the taxes, that extension is basically the votes they have for right now. Maybe one other sweetener. Everyone talks about no tax on tips. The Treasury Secretary thinks that it's the most underreported story in Washington, D.C., and they're going to get all these extras. The problem is, how do you do that already when the market is starting to push back on some of your other policies, like tariffs, as well as this potential Fed independence question?
If you are just joining us, welcome to the programme. Let's talk about that Fed independence question. Equity futures down and down hard, off by 1 percentage point on the S&P 500. And if you check out foreign exchange this morning against G10, Lisa, weaker against absolutely everything.
You don't want to hear your country named with Turkey when talking about the potential for central bank independence. And really, there's just one economist after another coming out and saying it tends to lead to higher inflation, a really devalued currency, and then potentially weaker growth. Annmarie brought up a really interesting point. How much, I don't want to say by design, but the idea of a weaker dollar actually benefiting some of the reshoring efforts. Is this part of the policy objective, at least up front, to try to bring some activity home? I don't want to say this is 3D, 4D, 5D chess. I'm just saying that is one question people are postulating this morning.
It's a pretty messy way of achieving that outcome, isn't it?
Very messy. It's also the reason why people rejected the idea of torpedoing the economy. And, this is sort of the discussion, though, that people are trying to understand and wrap their heads around.
The DXY is negative this morning by 1 full percentage point. The conversation will continue. Coming up in just a moment, Nela Richardson of ADP looking ahead to the week ahead with lots of economic data and earnings as well. Equity futures near session lows. We're down 1% from New York City this morning. Good morning to you all. You're watching Bloomberg TV. Equity softer here, down across the board. On the S&P 500, negative by 1%. On the Nasdaq, down by 1.2%. On the Russell, the small caps are negative by 0.9%. 3 hours away from the cash open. Let's get you some morning movers this morning. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. It's going to be a heavy week of earnings. Something like a third of the S&P reporting a buy market weight. Tesla, one of those companies, reports tomorrow, and the sell-side analysts coming out for it ahead of that. Shares down nearly 4%. Dan Ives of Wedbush warning of a code red as he has for some time if Elon Musk doesn't refocus his attention to Tesla. Barclays also cutting their price estimates and adding insult to injury. Reuters out with a story this morning that their lower-cost Model Y will be delayed, the launch of that, by at least 3 months. Meanwhile, we have some earnings to catch up on from last week, Netflix being one of them, reporting Thursday after the market closed a record profit. Those shares up 3 1/3%. Not only that, but the CEO saying, we've looked at the macro condition, we've looked at customers, and we're not seeing any change. Investors are hungry right now for a company that seems to be impact-free of tariffs, so flooding to that stock. Meanwhile, rounding things out with some M&A. You wanted a more loose regulatory environment, allowing for deals. Here you go. We finally got that. Capital One getting the nod from the regulators to go ahead and acquire Discovery Financial would make one of the largest credit card providers. Those shares are up 5%. There was some concern that the DOJ might last minute try to block it with the concerns of competition, but regulators over there saying that there wasn't enough evidence to do so. John.
Danny, thank you. More from Danny a little bit later. Some bankers in this nation, at least, hoping that's just the start for 2025. Danny, thank you. On our radar this morning, Chicago Fed President Austin Goolsbee warning against efforts to curb the central bank's independence.
There's virtual unanimity among economists that monetary independence from political interference, that the Fed or any central bank be able to do the job that it needs to do, is really important. I strongly hope that we do not move ourselves into an environment where monetary independence is questioned, because that would undermine the credibility of the Fed.
It's certainly been questioned over the weekend.
And it's really been explained by Kevin Hassett when he came out and said that they are studying it and looking at previous potential political decisions that this Fed chair made. Remember, the Fed chair was nominated by President Trump during his first term. A real question here about how much any decision by Fed members and any utterance by them will be questioned as political, even if they're not, right? I mean, how much this type of rhetoric really puts a tinge on all actions coming out of the FOMC.
The Supreme Court's going to be really important here, and the Fed chair actually said that they're monitoring this case closely, even though they think they're insulated from the Supreme Court decision. This was Trump that fired officials at the FTC and some other independent agencies. That is going to be heard at the Supreme Court, and that should put this, help put some of this to rest. The issue is, of course, the executive branch, the way Donald Trump sees it, he thinks he should have power over these agencies. And depending on how the Supreme Court comes out and rules, this could potentially be a massive fight between the Fed and President Donald Trump.
Playing out quite clearly in the equity market right now. Equity futures down across the board. On the S&P, we're down 1%. And in foreign exchange, just weighing on the US dollar, that's where you're seeing it in foreign exchange. The dollar's down against everything. To see the euro back up to 115. Only a few weeks ago, we were talking about parity. Wasn't that long ago at all.
People are looking at diversification and whether this is truly the U.S. is a loss of some sort of golden reserve currency status. The narrative can get ahead of the actual moves. Nonetheless, there is clear diversification, particularly from countries that might be looking at less trade with the United States.
Let's talk about the trade story. TSMC warning of the limits of its ability to keep its AI chips from China. The company writing in its annual report that its role in the supply chain, quote, inherently limits its visibility and information available to it regarding the use of its final products. We're getting a read on what's happening to the data, what's happening to trade. The data out of South Korea showing how President Trump's tariffs could dent shipments of export-reliant economies. South Korean exports falling 5.2% from a year earlier in the first 20 days of April, with shipments to the United States down 14.3%.
Yeah, and down to China just 3%. So you can see where the trade fissures really are. This comes at a time when there's not only concern about potential export restrictions, what happens to the ships that are coming into the harbor if they're going to suddenly get tariffed, how that works. It also has to do with just less demand, right, domestically and elsewhere. I just want to point this out. After Smoot-Hawley was passed, in those 5 years, international trade declined by 66% from the 5 years from 1929 to 1934.
What's interesting about the data, too, if you look more into it, auto exports, those really dropped. And guess what? We still have a 25% tariff on autos coming to the United States. But the Trump administration so far has not put the walls up on semiconductors. Those shipments actually increase. So you can see actually where the tariffs are hitting when it comes to Korea's export. Also interesting, South Korea, their trade delegation will be in town this week. So those conversations will be happening. A key question that they're starting to mull about in these South Korean officials is whether or not Trump himself will appear as he did with the Japanese negotiators.
That's a meeting to watch a little bit later this week. They're the stories on our market radar. Away from the markets, this is the top story worldwide this morning. The Vatican has announced the death of Pope Francis at the age of 88. He was known as the People's Pope for advocating for the poor and those fleeing war and hunger. Joining us now from Rome is Bloomberg's Flavia Rotondi. Flavia, welcome to the programme. Easter Monday turning to a day of mourning for Catholics worldwide. Walk us through what happened early this morning and what happens next in Rome.
Good morning. Good morning, Jonathan. Yes, it's been shocking news, I must say, for all over the world, particularly here in Rome, as you can imagine, as the Jubilee is absolutely ongoing and many tourists flocking just to, to go to the churches, to see St. Peter's Squares. Hearing this news in the morning has been really an incredible shock all over the world. And it's still hard to believe, to be honest, given the fact that just, yesterday, the Pope was meeting with the Deputy U.S. President Vance here in Rome. It's been a very, very short meeting, as you know, a very short conversation, an exchange of gifts, but has been seen as a sign of a kind of, recovery for the Pope that has been also attending a lot of meetings, attending a lot of celebrations in the last few weeks. Immediately after leaving the hospital, he just rested for a few days and then was out there meeting with, with other cardinals, having all over other engagements. So everyone was kind of hoping that this could be a sign that, it was kind of back on track. The whole thing was kind of back on track. And now, of course, the shocking news this morning. And as you know, now what's next? Well, of course, there will be the funeral and the conclave process that is supposed to start in 20 days before the death or the resignation, as was last time, of the Pope. The whole process hasn't started yet, of course. This is not the right time, but I'm sure that it will be in the next few days, a few technicalities to be resolved, and then the whole thing will actually start. So we can imagine that probably we are looking at a possible date for the conclave. I would say probably the first or second week of May, Jonathan.
Flavia, that will be the time to talk about the future. Let's reflect on the past. From Pope Benedict to Pope Francis, can you walk us through the change in leadership we witnessed in the Vatican?
Yes, absolutely. Quite a legacy for Pope Francis, seen as more liberal than his predecessor regarding a lot of topics, issues from abortion to immigration to, of course, civil rights has been quite the paladin of all people around, all people all over the world, all the minorities, all the fragile members of the society. So, of course, the question is, what's next? What's next? Shall we have a pope that is basically as liberal as him, or we'll have someone that is more traditionalist, so back to the more strict interpretation of the doctrine? This is quite a big question, and we will probably discuss it in the next few days. Yes.
Flavia, appreciate your time this morning. From Rome, Flavia Rotondi, Bloomberg's very own. Flavia, thank you. The sad news of the Pope's passing, Pope Francis dead at 88. We'll turn back to markets now, where investors are awaiting a slew of economic data this week. Nela Richardson of ADP writing, in a week full of backward-looking company earnings reports, data on big-ticket items like housing and durable goods provide a peek into the near-term growth outlook of the economy. Nela joins us now for more. Nela, good morning. It's good to see you. A lot of this data flattered by the pull forward that we're seeing from consumers. When do we start to get a clean read on some of the damage that's been done?
I don't think it'll be this week. I think we're still looking at a Main Street economy that hasn't yet felt the dent of anything that markets are talking about. So we're going to get this week, we're going to get some housing reports. Housing is really important, not because not just because it's the most optimistic thing you can do on the planet, economically speaking, which is to buy a house and take out a 30-year mortgage at these prices. You're saying I'm guaranteed income for at least 3 decades, but also because housing is an indicator that is consistent with the economy going into and out of recession. So what I think you'll see today and this week is strong new home sales, strong existing home sales, and pretty good durable goods sales, which all point back to a pretty resilient consumer economy.
At this point, can you say, or at what point can we say, that the soft data and the hard data have diverged meaningfully in a concrete way, and they are not going to converge in any kind of material way, that people can feel really bad, especially when they answer online surveys, but still go out and spend, but still have a job?
There is a huge time lag right now that we're all confronted with in this time of uncertainty, a time when we intellectually can process what's going on, but our spending behavior, our production behavior, our manufacturing behavior has not changed. And maybe this is a time when there is some circularity, that the real economy is so solid, it changes our sentiment. You haven't seen that yet? But it could happen because what we're seeing in the data, when you look at the labor market, initial jobless claims, housing, durable goods from last month, you're seeing a sense of resilience. You're seeing actually some dry powder sitting on the sidelines. When it comes to even small business formation, those numbers are still strong. People are starting new businesses at record highs still. And that is consistent with a strong Main Street economy, despite the level of elevated uncertainty.
Is there any sign that we're going to see a stop to that, given the fact that banks had a really positive outlook during earnings season and talked about how a lot of those mergers and acquisitions and other deals were just delayed but not put off entirely?
You know, again, timing matters here. How long is the delay? Because we thought that kind of financial activity would have happened months ago, and it has yet to pick up. So there's no certainty here, and I think the financial markets are really ruling the mergers and acquisitions activity right now. Not so true with the homeowner trying to buy a house. I mean, you're led by the baby crying in your 2-bedroom apartment more than you are on mortgage rates right now. And that is what's driving consumers, what they're seeing on the street, what they're seeing on that ground. But why it's important is consumer spending is what drives this economy longer term.
When it comes to consumer spending, though, a lot of this is likely stockpiling. My sister this weekend, I saw her. She's going out and getting a new car. She actually showed me the gifts she bought for Christmas because she's worried about price hikes that are coming down. Do you expect a softness on the back half of the year?
That is the biggest concern. I think you've really hit the nail there because, you know, toy manufacturing, a lot of these goods come from other countries. They come from China. This is the last place that a consumer wants to see the tariff hit when they are buying toys for their kids. So it could be that pull forward. The same with durable goods. You know, I checked my email. My car dealership is, you know, advertising tariff-free cars, which I thought was an interesting sales opportunity there. But yes, that is showing up. Definitely, it showed up in the trade volumes we saw earlier this year. So timing is everything in this economy, and we're still not seeing the timing work out between the policy and the behavior.
Everything Annmarie just said, we saw in retail sales. It was there in the data.
And so now the question is, how long is that going to last? And to that point that you both were making, at what point does that lead to weakness? How organized are people? Christmas gifts?
I really hope my nephews aren't watching. If they are, the Legos are hidden underneath the steps.
90% of ornaments come from China into this country.
Oh, yeah.
So,
and they were taking the price tag off.
if you want to decorate the Christmas tree, anyway, there you go. Nela, thank you. It's good to see you.
Good to see
Nela Richardson there of ADP. Could just reuse the decorations, of course.
I was just going to say, I mean, don't you have the same decorations that you put in storage and you take them out every year, right after Thanksgiving?
Nice,
make sure.
You do things on trend. OK, it's too early to talk about this. Months away. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. We begin with the breaking news out of the Vatican, which announced the death of Pope Francis at the age of 88. He assumed the papacy in 2013 and became known as the People's Pope for advocating for the poor and for those fleeing war and hunger. On Sunday, he had met with U.S. Vice President J.D. Vance. Elsewhere, U.S. Defense Secretary Pete Hegseth is said to have shared confidential military details in a chat on third-party app Signal for a second time. The New York Times reporting that Hegseth created and sent sensitive information to a group that included his wife, brother, and personal lawyer about strikes in Yemen in March. Meta's Mark Zuckerberg and JP Morgan CEO Jamie Dimon were among the top insider sellers ahead of President Trump's sweeping tariff announcements. Zuckerberg sold over 1 million shares of Meta. That amounted to $730 million in the first 2 months of the year. Dimon sold over $230 million worth of his company's stock. And that's your brief. John.
Not bad timing. Not bad timing. Danny, thank you. Up next on the program, tariffs trigger panic buying.
Consumers are actually starting to feel the tariff impact now, trying to pull forward some purchases, but the weakness will come, once we see the other actual effects.
Jeremy Jansen of Wells Fargo joins us next, live from New York City. You're watching Bloomberg TV. Equities here negative across the board. We're down 1% on the S&P. We're down by 1.1 on the Nasdaq. The Towns in the FX market. The dollar getting absolutely hammered. New lows for the dollar for 2025. We're down by 1%. The dollar is weaker against everything in G10. Kevin Hassett, the National Economic Council Director, the top economist to the President of the United States, asked about whether they could remove the Fed Chair, Jay Powell, and the response was basically, we're looking at that.
We're studying it. And as we heard from Terry Haines, they've been studying it for a while, so keep on studying and maybe it won't have any consequence. Nonetheless, he didn't push back, and he had an opportunity to, even with understanding what the market was doing in response to this suggestion.
As they study that, euro-dollar climbs 115.27. Under surveillance this morning, tariffs trigger panic buying.
Consumers are actually starting to feel the tariff impact now. I think you could see much more of this, in the data ahead. Until consumers start to see that, they won't, they're not exactly changing their behaviors yet. They're trying to pull forward some purchases, but the weakness will come, once we see the other actual effects.
So here's the latest this morning. Consumers pulling spending forward as inflation expectations soar to multi-decade highs. Jeremy Jansen of Wells Fargo writing, the supply chain overall logistically remains very healthy. U.S. trade policy is expected to remain dynamic for quite some time. That is a diplomatic way of putting it, Jeremy. Welcome to the program. You oversee supply chain finance, so help us understand what you see across companies right now, how they're managing things from Mexico to Canada to China and elsewhere.
Yeah, hey, good morning. Thank you for having me. Our data here at Wells Fargo does suggest that Chinese imports into the U.S. or us purchasing receivables from those suppliers, it has seen an increase in Q1 of this year versus prior year. We did not see a similar increase when we look at other countries in our portfolio.
How much, Jeremy, do you see this pull forward as not necessarily being predictive of the future, but really a sign of how much weakness there will be going forward in the months to come?
Yeah, I think it was planning on behalf of our clients, and we'll continue to watch the data on a weekly and monthly basis and see how that shift or what shift occurs now that the tariffs are more in place there with China.
Jeremy, how much are the companies who you work with taking a page from the pandemic playbook when it comes to managing their supply chains and trying to get ahead of any kind of fissures in how they get their goods?
Yeah, I think significantly, right? The fact that we have been here before in 2018, 2019, our clients do have a playbook specifically around shifting that distribution channel away from China. I think we saw it in 2018, 2019, where roughly 22% of the supplies coming into the U.S. or imports were from China. That shifted drastically to low teens. So our clients are understanding how to do this. Certainly the announcements on April 9th helped to pull forward that strategy a little bit. So that certainly that playbook does exist. I wouldn't say our clients had to dust it off, right? They keep it fresh in what is a dynamic global supply chain.
But what makes this different than 2018 and 2019? Is it just the uncertainty that you're never quite sure where the end destination is going to be?
I think that's a great way to think about it. There is more uncertainty here than there was in 2018 and 2019.
What are your clients most hoping to hear from policymakers in Washington?
Yeah, I think certainty, right? Back to that word. Where does this land? Again, our clients are vigorously working on many different strategies on how to manage the increased costs that come along with tariffs. And typically, what we're hearing is that's a threefold approach. How much of that increase can be borne by the suppliers? Corporate profit margins are higher than they were in 18 and 19, so that will allow our clients to absorb some of that tariff impact. And then last but not least, how much of that is ultimately passed on to the U.S. consumer?
How much, Jeremy, do you see a risk that the economic consequences of some sort of ongoing uncertainty in trade could end up being similar to what we saw during the pandemic? I mean, I was looking at Torsten Slok over at Apollo, and he said that if the tariff rates are maintained where they are currently, he expects a 90% chance of a U.S. recession.
Yeah, I'm not an economist for Wells, right? So I don't want to get into chances of recession. I like to speak directly to the impact to the supply chain and the impact to our clients. Certainly the news on April 9th decompressed our universe a bit, because our clients can point back to the playbooks that they had in 2018 and 19, where they were extremely effective at distributing that supply chain globally.
Are you saying, Jeremy, that we're not going to see the same kind of disruptions maybe in just how quickly some of the goods can get on the shelves because of just how quickly they can ramp up those playbooks?
I would also point to the fact that the supply chain overall is incredibly healthy, right? When you look at key supply chain measures relative to pre-COVID, whether that's shipping costs, whether that's inventory availability on the shelves, those metrics that we watch are very healthy and, again, very similar to where we were pre-COVID.
Hey, Jeremy, appreciate the take. Jeremy Jansen there of Wells Fargo. A more constructive take on where we are at the moment. I think it's important to point out, based on what Jeremy had to say there is a resilience this time where there wasn't before, except this time the test is much bigger than it was back in 2018, 2019.
Which is the reason why people are having a hard time figuring out how to wrap their heads around this. There's a resilience on a couple fronts. There's a resilience when it comes to their balance sheets, and there's a resilience when it comes to their experience already of the supply chain disruptions that we saw back in 2020.
We kept talking about this playbook and the fact that they're using that same playbook. I would say what's different, though, from COVID is there was always this idea that we're going to snap back and go back to normal, whatever normal was before COVID. Now, the destination is changing, and the goalpost keeps changing on what this administration wants to see when it comes to trade. Maybe it's deals, or maybe it is tariff walls go up to bring in revenue and reshore back to the United States.
COVID was a temporary shock to the system. This could be a very long-lasting shock to the system, and we're still trying to figure that out. How much longer, I don't know. The focus at the moment is on deals. We'll see if we get some deals. 90-day pause. The clock is ticking. Let's see if we get those deals. But ultimately, this feels something like a really prolonged shock to the system that we still have quite fully internalized.
Just to build on that, this idea of any kind of analog to 2020, it's very different. Where is the safe country to import from? Where are the havens that you can go to where you can have a concrete sense that the tariffs are going to be substantially lower? And then how do you price for that in a fungible moment when it comes to just what those rates will end up as?
If you are just joining us, welcome to the program. Equities here, session lows were down by 1% on the S&P 500. This dollar is a whole lot weaker. In the next hour of Bloomberg Surveillance, we'll get a take from Barbara Doran of BDA Capital, Scott Lincicome of the Cato Institute, Leland Miller of China Beige Book, and Tom Tzitzouris of Strategas from New York City. This is Bloomberg.
There's so much noise out of this administration.
You can suddenly have all sorts of other things questioned about the Fed if it's in direct conflict with the White House.
So the Fed, on that basis, will, I think, continue to hold fire.
I think that the Fed will do as much as it can to do as little as possible.
We're still in a world where all boats will be moving together.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to all. The second hour of Bloomberg Surveillance starts right now. Here's a snapshot of the price action. Your scores look like this. Equity futures down across the board. On the S&P, we're down by 0.9%. In foreign exchange, the dollar weaker. New lows for 2025 for DXY, down by 0.97%. And in the bond market, take a sneak peek of 2s, 10s and 30s. Yields down at the front end, up at the long end. This line right here from the NEC director, Kevin Hassett, rocking this market. The president and his team will continue to study that in response to a question about whether they could push Chairman Powell out early.
So right now what you're seeing in markets is essentially traders pricing in the prospect of a Fed motivated to cut rates more quickly and then allowing the long end to actually become a little bit unmoored. The idea that people will be less confident in Fed independence over a longer term and are going to demand an extra premium to own longer term U.S. debt. You are also seeing diversification away from U.S. assets into, say, Japanese bonds, into emerging markets bonds, elsewhere to just get some sense of diversification.
That confidence is being damaged slowly. You see it in stocks, you see it in bonds, you see it in foreign exchange.
And what's so interesting about this is because of what we're seeing play out in financial markets right now and this concern about the credibility of the dollar, the concern about the credibility of U.S. Treasuries is exactly why in his book in 2021, Kevin Hassett said firing someone like Jay Powell was not something we would want to do because of that damage and the concern that damage that could happen now. What he said over the weekend was it's an option that they are weighing, and he basically is saying that they think that the legal parameters or how they're viewing the legality of this has changed.
This is the public feud. Let's talk about the private one. Behind closed doors, based on reporting, Politico suggesting that the Treasury Secretary Scott Bessent is leaning on the president and warning him of what would happen to financial markets. The New York Times suggesting that the president is listening to him. And that's why he's not pushing forward with this. So I would say the discussion in public sounds quite different to the discussion in private based on the reporting over the weekend.
Yeah, how much is this a way of expressing displeasure? And he has a right to express displeasure. He is a U.S. citizen versus actually engaging with action, which is the reason why Kevin Hassett's commentary was what got people's attention, because it suggested maybe there was more behind it. There's a bigger question here. How much is the market an ultimate check on what President Trump does? How much does President Trump take a look at any kind of disruption in markets and change course as a result? We have seen that. Is that going to be a guiding light? Still unclear.
We've seen it twice now, most recently with the Fed chair, with Secretary Bessent, according to reporting, trying to tone down the rhetoric and trying to make sure that the situation remains that Fed chair will leave when his term is up in May 2026 and not be ousted before. And also the reprieve, the 90-day reprieve on tariffs. The Treasury Secretary saying this is doing damage to financial markets. This is what the Treasury Secretary has to think about Powell. Monetary policy is a jewel box that's got to be preserved. You can voice your opinion, but you can't oust someone.
Neil Dutta of Renmark just publishing another Fire Powell higher wash cycle. While firing Powell is bad, replacing him with Kevin Warsh is not much better. The take from Neil Dutta this morning.
Kevin Warsh tends to be a hawk, as you mentioned earlier. So he'd be more inclined in keeping rates higher for longer, which is more akin to exactly what this president does not want to see. Look, President Trump nominated Jerome Powell. This was President Trump's Fed chair. Whether he actually knows what he wants and how to get it, hard to see. What exactly motivating? Big question mark. This is the reason why you see people paralyzed. How do you deal with this in a market that is used to extrapolating out to extremes? You extrapolate this out to an extreme, you'll get an extreme result. Is it really worth doing that? That's really the question.
What did Apollo's Jim Zalta tell us a few weeks ago? Macro paralysis. That's what it feels like at the moment. As for Kevin Warsh, the Wall Street Journal indicating over the weekend that even Kevin Warsh is engaged on this topic and warned the president not to do this.
No Fed official or anyone involved in the economics profession with any type of credibility has been suggesting that it makes sense for some sort of executive authority to have power over a central bank. You have seen that time and time again. Witness Turkey. And when you start talking about Turkey versus the U.S., you have a problem.
Also, you have to think Kevin Warsh sitting in that seat thinking maybe I am going to get the nod and I'm going to be able to sail through confirmation. What happens to me in my position if Trump is unhappy with my decisions? So he's an individual that's looking at the big picture and saying this would be a terrible precedent to set.
Things ease in markets right now in the last couple of minutes at least. Equity futures down by 0.8%. The cash bond market resumes trading at 7 a.m. Eastern time, and as it resumes, yields are just a little bit lower at the front end. We're down by 2 basis points. At the longer end of the curve, we're up by 6 on 30s. In foreign exchange, euro dollar off session highs, but still pretty punchy stuff. 1:15.22, positive on the session by more than 1 full percentage point. Coming up this hour, we'll catch up with Barbara Doran of BDA Capital as stocks look to rebound from last week's losses. Leland of China Beige book as China warns against making deals with the United States. And Tom Tzitzouris of Strategas, a bad company, on the future of Fed independence. We begin this hour with stocks lower as tensions soar between the President and the Federal Reserve. Barbara Doran of BDA Capital writing any legitimate threat to the independence of the Fed is to be taken seriously and negatively, as it has the potential to undermine both the dollar and US assets as safe havens for investment. Barbara joins us now for more. Barbara, good morning.
Yeah, good morning.
Let's talk about that first line in that quote. Any legitimate threat. Is this a legitimate threat?
Yeah, that's the question. I mean, in the past, you would think, no, it's not legitimate because it's so obvious, the negative ramifications of this. But given the unpredictability we've seen in this president, anything's possible. And if the Supreme Court, we know there's, as you mentioned earlier, that the cases before them, if they rule that the president can replace people in these other independent agencies, then I think he might consider it. But if Besson is in there, and Besson does seem to be gaining an influence with the president, hopefully it's not legitimate.
We started this year with a rebalancing towards assets elsewhere. European equities really started to perform. Dollar weakness kicked in. This seems to have taken on a new phase over the last month or so. What do you make of the new leg of this? What's behind it over the past few weeks?
Well, I think with the tariff uncertainty, I mean, we had the pause. You saw what happened with the market. But I think there is a real question about the credibility and legitimacy, of this as a safe haven. As we've seen and everybody's observed, we've had very unusual behavior. As tariffs go up, we really should have the dollar getting stronger as a flight to safety. It's not happening. And in fact, the dollar is down 5% against the euro and the pound, and also 6% against the yen since early April. That's a lot. I mean, as you said earlier, it's been parity just relatively recently, a few months ago. So it's a real question, and it's hard to see that changing because even though we have this 90-day pause, it is just temporary. And so we also are waiting to see what they decide on semis, on pharma, on lumber, on copper, and all sorts of things. So there's no way yet to gauge the impact of these policies. Businesses are still on hold. Consumers are, and every survey that's coming in is showing, sentiment continues to decline. So, we'll see what happens, but it's not good.
Well, this speaks to the macro paralysis that Jim Zelter of Apollo, as John was mentioning earlier, talked about. How do you gauge your longer-term asset allocation at a time where so much has yet to be determined? Have we seen enough to say definitively that you need to diversify away from dollar-denominated assets versus traditional portfolios of, say, 5 years ago?
Maybe, because the problem here is the question is always how much is the market discounting? All right, the Nasdaq is down 15% or plus year to date. S&P down 10%. It's probably discounting a lot, but we don't know the worst case. It seems that the worst case is probably over in terms of the tariffs, but there is no way to judge. So, gold continues to make new highs. I think it will continue because the move toward gold started before this. And that was really in 22 when we froze the assets in Russia and treasuries suddenly like, oh, maybe treasuries aren't the safe haven. And I think this continues it. So the problem with diversifying away, say, to Europe, all the economies, if our worst case tariffs do come in, they're going to be hurt as well. So their growth is going to slow. So I think that for now, you just have to you diversify a bit, and I think a lot of investors are trying to reorient their stock portfolios to more dividend, more high quality, and including gold.
At a time when so many people seem to be whipsawed by sentiment, what's the guiding light? Data is messy. The soft data and the hard data aren't cohering, and we're hearing about the lag time between the two. Earnings are kind of pick your own adventure, throw a dart and figure out what your projection is. Where is this sense of your North Star?
There isn't, I think, because right now all the data that's been coming in, whether it's the CPI, PPI looks good, retail is still good, balance sheets for both consumers and managements are good, but that's looking backwards. And what you're starting to see, earnings season started in earnest, as we know, a couple of weeks ago with the banks. And the banks, again, looking forward, they see no problems as yet, and they're not really increasing the reserves. But a lot of company managers are starting to add, well, we can't really give great guidance. There's this macro uncertainty, read tariffs. So it is really hard. I mean, for instance, in our portfolios, we're not selling because in the space of a tweet, the stock market could be up 1,000 points. And that's the real problem here. There is no predictability. But you have to you say, okay, I think the worst is over, so we're holding. If you have cash, you know, there are opportunities at individual stocks coming up. You can selectively take nibbles, but I would not be buying in a wholesale way. There's just no way.
What would make you want to buy?
If we had some certainty in tariffs, which is hard to see right now, we've got 90 days, and if we had more of a process, I mean, as we saw, there's a real question about the methodology when he brought out his famous chart there, and I think there's been a lot of questions about that. You know, if for some reason in the next few months we saw more stability, we had the tariffs that were settled, and we're sure that they were settled, and it was a way to measure the impact, then, you know, and again, depending what that is, you know, if they're too high, even at this 10%, how inflationary are they? You know, the Fed has said they can't act because they don't know, you know, how much is going to impact inflation, how much will growth slow. And you're seeing around the street, every house is taking down their estimates on GDP growth, upping their inflation, but we really don't know how big it will be.
Terry Haines joined us earlier from Washington. He basically said the market's way too focused on tariffs, Jay Powell's not going anywhere, and that you have to start focusing on tax cuts. This extension of TCJA and maybe another sweetener, is that enough to be excited about year end?
Not for me. I think, they were right to focus on the tariffs. And what the administration, I think, is trying to get us to focus on coming tax cuts. But really, how deep can the cuts be? I mean, we're talking really an extension of the cuts. And there's a give and take going on right now. But I don't see them being draconian. I mean, how can they be? I mean, without exploding the deficit even more. So, and deregulation, I mean, certainly the approval of Capital One taking over Discovery, that's, also will give some investors hope that, deregulation is starting. But that will help on the margin. But I think the tariffs are so important because that affects the entire world.
You touched on something that I've heard quite a few times over the last week. People who are super bearish but aren't selling because they're worried about one positive headline crossing the Bloomberg that leads to some massive upside move on the S&P. And I wonder actually what's going to make people start selling again, because in the meantime, the data seems to be distorted by what we're seeing in a pull forward of purchases by consumers, companies alike, that maybe that data's flattered for the time being. What would it take to start selling again in this equity market?
Well, that is a good question, because I think, what we've seen to date, and certainly been true on retail behavior, is buying on weakness, which has not been a good thing. And so I think that once we get some established, presence here, or even any time we have a sudden tweet that sends the market up 1,000, you got to be lightening up. So, and I think that's, like last week you didn't have time, or 2 weeks ago when it happened, the market was up 1,000 and it gave back half of that the next day. So the rapidity of these moves, it's very hard, unless you're a trader or you're algorithmic trader, it's very hard to take action. So, I think, for us, it's just you are in good stocks, you're in good fundamentals, high quality, and you just have to wait out this storm, and storm it is.
Futures right now down about 1% on the S&P. Barbara, good to see you. As always, thanks for dropping by.
Thank you.
Barbara Doran there of BD8 Capital Partners. Speaking of gold up so far this year by close to 28% now, year to date.
Yeah, the diversifier at a time when it seems to be a hedge against absolutely anything under the sun, recession or inflation. To your point, and I think this is important, Stuart Kaiser of Citigroup came out yesterday in a note and said investors should fade a pause of the sell-off absent good news on tariff deals. This is the key point. Time is not the market's friend. Ongoing uncertainty means risk to EPS and GDP forecasts.
Up next on the programme. Sorry, I thought you were continuing. OK, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Starting with breaking news this morning out of the Vatican, which announced the death of Pope Francis at the age of 88. He was known as the People's Pope for advocating for the poor and those fleeing war and hunger. Despite his efforts, Francis struggled to fully address the legacy of child abuse by clergy members and faced criticism for not doing enough to hold perpetrators accountable. Well, U.S. Vice President J.D. Vance had met with Pope Francis yesterday before traveling to India, where he will hold a bilateral meeting with Prime Minister Narendra Modi. The trip comes as the U.S. threatens to increase the 10% tariff on Indian exports to 26% if no deal is reached by the end of Trump's 90-day pause. The Supreme Court temporarily blocked the Trump administration from deporting a group of Venezuelans to El Salvador. Justice Alito dissented, writing the court acted on unprecedented and legal questionable grounds. The court intervened around 1 a.m. Saturday morning. Justice Thomas joined Alito's dissent. And that's your brief, John.
Danny, thank you. Appreciate it. Thank you very much. If you are just joining us, equities down on the S&P by something like 1%. The dollar a whole lot weaker. Up next, threatening Fed independence.
The only thing that's gone up actually is interest rates, because we have a Federal Reserve Chairman that is playing politics. If I want him out, he'll be out of there real fast, believe me.
We'll get the view of Scott Lincicome of the Cato Institute up next on the program. Live from New York City, you're watching Bloomberg TV. Krishna Gua of Evercore with the quote of the weekend following this Federal Reserve independence debacle. If you like the tariff debacle in markets, you'd love the loss of Fed independence trade. Evercore's Krishna Gua there. Equity futures right now on the S&P negative by 1% on the S&P. On the Nasdaq 100, we're down by 1.2. In the bond market, yields lower at the front end just a touch by 2 basis points. At the long end, up by 6. We'll get into that later in the program. In foreign exchange, it's the dollar weakness that gets our attention. The dollar weaker against everything in G10. Euro dollar 115.14. Under surveillance this morning, threatening Fed independence.
The only thing that's gone up actually is interest rates, because we have a Federal Reserve Chairman that is playing politics. Somebody that I've never been very fond of, actually. But he's playing politics. Interest rates should be down now. If I want him out, he'll be out of there real fast, believe me.
So here's the latest this morning. Stocks and the dollar falling as President Trump ramps up threats to fire Fed Chair Jay Powell. The president posting on Truth Social, going into the weekend, that Powell's termination cannot come fast enough. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we spoke to Terry Haines a little bit earlier. We talked about the bark. He played down the potential bite. What are you hearing down in Washington?
Yeah, hey, John. Well, exactly that we have to really see how far this administration could go when it comes to removing Jerome Powell. Powell himself says that he doesn't think that President Trump has the legal authority to do so and that he wouldn't step aside if asked. And in theory, he is supposed to be protected by the Federal Reserve Act of 1913, which shields him from being fired without cause. Still, we've heard some White House officials in recent days really ramp up their rhetoric alongside President Trump, much as Terry Haines said that he felt that Kevin Hassett, for example, was playing along with President Trump's playbook, saying that they are seriously looking into some potential pathways here to remove Jerome Powell if necessary. The big question, of course, is what the legal precedent looks like. And this administration has asked the courts to overturn one legal precedent that we're watching closely called Humphrey's Executor. There is a Supreme Court case coming up soon that very likely could potentially put this up in play. It doesn't necessarily have to do with the Fed. Instead, it has to do with the National Labor Relations Board. But Powell himself has said that he is watching it very closely as we try to figure out exactly what this White House could potentially do moving forward. Still, it is widely seen that President Trump is trying to sort of shift the blame here when it comes to his tariff policies and the future impact on the economy. But it probably goes without saying that even by removing a Fed chair, when it would not change the Fed's dual mandate. And there are still 11 other voting policy members on the FOMC. But, John, we are not expecting this to go away because President Trump is making clear that lower interest rates in his mind would go hand in hand with tariffs. And Bloomberg Economics just revised its forecast last week. They're now predicting 125 basis point cut in December.
Tyler, appreciate the take down in Washington, D.C. Thank you. It's another threat to institutional credibility. Joining us now to discuss, Scott Lincicome of the Cato Institute. Scott, welcome to the programme. Speaking of threats to institutional credibility, the IMF World Bank meetings take place this week in the nation's capital in Washington. What kind of credibility do those institutions have left? What is their role to play at a time where threat globally is very much under threat?
Well, you hope that they can still try to steady the ship a little bit, try to calm down some of the uncertainty that's out there. But the reality is that everybody's looking at the White House, and those institutions are on the outside looking in. And from the White House, it's all tariffs and trade policy and uncertainty. And that, I think, is going to continue to guide regardless of what those institutions are doing.
Well, let's talk about trade and these potential deals to be had. We know South Korea's top trade official visit Washington this week. Do you think we're going to get a number of deals before the 90-day reprieve is up?
I think we're going to get something. That's almost a necessity from the White House at this point. The real question is what we're actually going to get. Trade deals typically take around a year and a half to complete if you're talking about a comprehensive trade agreement. Doing something in just a few weeks, given the politics of trade policy back at these nations' capitals, given the complexity of the issues here, this isn't just about tariffs, it's about non-tariff barriers too. That takes time. And so the question isn't really, are we going to get any deals? It's what deals we're actually going to get. And there, I think they almost have to be superficial deals focusing mainly on tariff cuts or some guaranteed purchases of things like LNG, nothing that really gets in the weeds of those regulatory and other barriers.
It feels like what these trading partners need to do is find a way to narrow the trade surplus they have with the United States. Who is best positioned for that?
It's governments that have still some ability to purchase directly, so state-owned energy companies, and that. But beyond that, though, a lot of this stuff is difficult for private industry-led countries that don't have those types of levers to pull. The Chinese can, but of course, that's a bigger fish to fry.
If there's a role for some of these international institutions that are devoted to facilitating trade, maybe it's just bringing people to the same table. And that's a real question, sort of merging these two ideas of what is the purpose of the IMF at this kind of moment, as well as when do you start seeing deals? Are you expecting to see a China-U.S. meeting during this week's meetings in Washington, D.C.?
I'd be really surprised. It still seems that both sides are not ready to get down to talking. With China sending back multiple Boeing jets over the last week and shutting off purchases of American energy, I think we're still in the shoot first phase of that relationship.
Scott, is there anyone out there making a good argument to maintain freer trade?
You mean besides us at Cato, right? Look, I think for those of us who support open trade, we're going to have to let the market speak for a bit here, and there's going to be a bit of a hot stove touching period. I'm confident, though, that at the end of this, we're going to look back and say that it was a big mistake. It's already looking at, the manufacturing weakness in the Philly Fed survey and the Empire survey. You're looking at the Sell America issues going on in the markets. This seems like already this experiment has gone wrong, but it is going to take a little bit longer for my side to get back in the game.
Of course, apart from the Cato Institute. Scott, appreciate your time. Thank you, sir. Scott Lincicome there at the Cato Institute. Going into a big week for the IMF and World Bank, looking for some real leadership where there hasn't been much. Let's put it that way.
Well, there's been a real tension. And always when you have IMF meetings, there tends to be an elephant in the room. The last IMF meeting, it was the potential for Donald Trump to become president again. The meeting before that, it was the increasing tension between China and the rest of the world when it came to trade. Now the elephant's there. It is in the face in terms of the breakdown of the international trade order. What is their new role? Because this is not the Bretton Woods type of accord that you've seen in the past, given the fact that the U.S. led that and is now leading sort of the breakup of that order, at least on the surface.
What's the argument for freer trade? The Cato Institute says, wait. See what happens. Equity futures on the S&P 500 negative by 1.3% on the S&P. The dollar weaker across the board in G10, euro dollar 115.30. And in the bond market, yields a little bit higher at the longer end of the curve, the 30-year. That yield is up by close to 8 basis points. Up next, Leland Miller of China Beige Book as US-China trade tensions continue to ramp up. Live from New York, this is Bloomberg. We're taking another leg lower in the last 10 minutes or so. Equity futures now down by 1.25%. On the S&P, on the Nasdaq 100, we're down by close to 1.5%. With 2 hours from the cash open, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Just want to look at some of the reasons that tech is underperforming this morning. Some of the drag coming from news out of TSMC. Its ADR down nearly 2% this morning. A couple things going on. For one, its Arizona factory posting a loss. For two, the company warning that it's not going to get as much money as it expected, or maybe even any money from the government, the U.S. CHIPS Act. And finally, saying that it's going to have a hard time ensuring that its customers are complying with different American export controls. Now, speaking of customers, one of the biggest of which is NVIDIA, which is also one of the companies leading the losses in the S&P 500 in the pre-market session, down 3%, possibly just because of the risk-off nature of today's session. NVIDIA is losing, maybe because of that TSMC news, but in general, chip makers are struggling in the trade today. Again, as is tech as a whole, Google one of them. Now, a couple things to look out for Google as it falls 1.25% in the pre-market. It's going to report earnings on Thursday, but Alphabet also has an event risk to get through today. It's going to be facing a U.S. judge trying to make the argument that it shouldn't be broken up, something that the U.S. government has wanted for this company. They're facing a judge that already once ruled against it and comes just a few days after a separate judge ruled that Google indeed had conducted an illegal monopoly in online advertising technology. John.
Hey, Danny, appreciate it. An update there on Alphabet. That stock is lower in the pre-market, going into the opening about 2 hours away. On a radar this morning, our top story, President Trump's threats against Fed Chair Jay Powell weighing on the dollar and equity futures. The National Economic Council Director, Kevin Hassett, saying Trump is studying whether he's able to fire him. I want to talk about the bond market, Lisa. We talked about this briefly. Yields down at the front end, higher at the long end. This long bond is in focus big time over the past few weeks.
If you have a Federal Reserve that is incentivized politically to lower rates in response to demands from an executive branch, that would unleash the prospect of higher inflation, a higher premium in terms of U.S. assets and how much investors externally are demanding to own them. And that is the reason why you see on the margins lower short end yields and higher long end ones. At what point does that get the attention once again of this president? Right now, it is a less liquid market given the holiday. At the same time, at some point, this will trigger a response.
What really I was surprised about Kevin Hassett over the weekend was the fact that he came out with this book and talked about all the reasons why you would have to keep Jay Powell and the reason why they kept him and Trump won, even though he was nominated to be the Fed chair during Trump won. But also, the fact of the matter is that he said the option is open. He left the door open, which makes you think that they are having more serious discussions behind the scenes on a legal pathway to do this, not just the president in the Oval Office or on Truth Social airing his grievances and annoyance with the Fed chair, which we saw a lot, the jawboning of Fed in Trump 1.0. It seems like this is taking over another conversation of how they could do this if they wanted to engineer this.
So how much weight can you put on the reporting over the weekend? So put two reports together, one from Politico, another from the New York Times. Politico suggesting that the Treasury Secretary Scott Bessent is leaning on the president, suggesting that this would be terrible for markets. The New York Times is indicating that the president is actually listening to him and not going forward with this move because of exactly that. Kevin Warsh was engaged, according to what we heard from the Wall Street Journal over the weekend as well, engaged in a conversation with the president about all of this, and he pushed back and said, you don't want to do this. So where are we really in private versus where are we right now in public, which is a messy feud?
I'm guessing that if people really believed that he was serious about this, we'd have an even bigger reaction in markets, and probably it would get pretty messy. I had one analyst talk about a significant downdraft in stocks as a response to this, not what we're seeing today. This is the difficult thing, though. People said that about tariffs as well. And then he came out with that laundry list of tariffs that exceeded anyone's expectations. So, you know, it's very difficult to speculate in this macro paralysis that we all seem to be in.
We are not even at 100 days yet of Trump's second administration, and we still have 12 months to go before Powell's term is up. So if these conversations are happening now, you have to think, where will the conversation be 6, 7, 8 months down the road?
Seeing where the FX market is right now, that's for sure. Euro dollar at the moment, 115.32, a much stronger euro and a much weaker US dollar. Another story for you, a trial against tech giant Google. Starting today in federal court, Google and the US government are set to argue over how to restore competition in online search. Thursday, a judge ruled the company acted illegally to build a monopoly in online advertising.
This is so interesting to me. This was supposed to be the deregulatory, pro-business government that was going to celebrate national champions, including including all of the tech CEOs that sat behind him in the inauguration. He was going to say, these are our champions, let's lift them up. And then it turns out that the same kinds of antitrust policies that were against big tech under President Biden are the similar ones that are being engaged with under President Trump. So here's the question. Is this just tech? The Discover Capital One deal seems to suggest maybe it is. And number two, how far are they willing to go if it does remove some of the luster of the biggest tech companies that were really the poster children of American exceptionalism?
Very little daylight between the Biden administration and the Trump administration when it comes to this case. And we are going full circle. This case came up in 2020 during Trump's first administration. It was that Justice Department and a number of states that brought this challenge. Then you have the Justice Department under Trump in March coming out with their revised proposal for a final judgment, and it looks exactly like what came out of Biden's Justice Department. When it comes to big tech, those individuals standing behind the president, I think, was less so about the president saying these are the national championships and more about those people saying, we need your help. Because we have a few court cases and a few issues as well in Europe that we're going to need your executive branch to help us with.
Not much daylight at the moment between this administration and the last one on this issue. Alphabet is down by a little more than 1% in the pre-market. Let's turn to the latest on trade. Japan firing back against trade talks with the United States. The country's prime minister saying it won't keep conceding on US demands to reach a deal over tariffs. Tokyo looking to finalise its strategy for a second round of talks before the end of this month.
So they want to get something done before the 90-day reprieve. The issue, of course, that this prime minister has is that he's not doing so well in the polls because of two reasons. Japan really wants to make sure they're safeguarding their agriculture, but the United States wants to put more things like rice and those kind of products in Japan, and they want to also make sure they're safeguarding their auto industry. And the U.S., a number of officials have come out and said, look how hard it is for our companies to meet the safety barriers to Japan's entry. They will not accept the U.S. justification for whether a car is safe or not. These are where it's going to get very challenging for a number of countries to meet U.S. demands when it's going to start impacting them domestically. And you see that playing out in the Japanese press over the weekend.
Getting trade deals are very, very complex, very difficult, and it takes a long time. Here's the latest on the China front. China warning countries against making deals with the United States that could harm Beijing's interests. China's Commerce Ministry writing, if such a situation occurs, China will never accept it and will resolutely take reciprocal countermeasures. Leland Miller of the China Beige book joins us now for more. Leland, welcome to the programme, sir. Let's talk about China. The president keeps saying China wants to come to the table and make a deal. Are you seeing any sign that China is willing to come to the table?
Not yet, but I don't think coming to the table is that big a lift for either side. If you read the headlines, it makes it look like the United States is spiraling in one direction, China's spiraling in the other direction. There's just nothing that could bridge the gap. But the real gap right now is these enormously high tariffs. But there's just not that much difference between 145% tariffs and 145,000% tariffs, because you just don't have Chinese goods that are competitive at anywhere near that level. So there is whether it's 145 down to some other level, to 125, 105, 85, these are arbitrary levels. There's nothing economically significant about staying at these levels, which means the president could take these levels down, not be giving up anything of economic substance, but bring the Chinese back to the table. Are they prepared to do that? Maybe not yet. But they have that card in their pocket, and I think that if that was something that the White House dangled, then I think that the Chinese would be receptive to it.
Leland, once the negotiations begin, what would you anticipate the negotiations would be over?
Well, that is the big question, and that's actually the big question with every trade deal. The talk coming out a lot of these negotiation rooms is, what in the world does the United States want? Does it simply want to narrow the trade deficit? Does it want some sort of other victories in other lanes? Nobody really knows. I would say that the U.S.-China trade negotiations could go in two different directions. You could have a TikTok, a fentanyl cooperation, and maybe some concessions about Panama Canal properties, along with some more buying, which is basically phase 1+. That's something the Chinese are probably very interested in coming to the table with if they can get a receptive audience to the U.S. side. If it's more than that, if there are more USS, this becomes a lot more difficult. Certainly, the United States is not going to be able to tell China to restructure and have that happen. So basically, the administration has to come out with a list of demands, and then the Chinese can see whether they're serious or not. Until that happens, they're talking past each other.
Leland, who has the more leverage at this point, given the fact that some people believe that the U.S. will be disproportionately hurt by some of the export bans or the export restrictions put on by China?
Well, it's tricky because if this were a bilateral spat, the U.S. would have considerably more leverage because of the size of the trade deficit. That doesn't mean that China hasn't worked for years in order to create supply chain choke points, to create other vulnerabilities, in U.S. Supply chains. That's absolutely true. But I think the United States would have more in a one-on-one matchup. The problem is this is going on in the backdrop of huge dislocations around the globe in trade. As tariffs are being weighed, are they going to stay lower? Are they going to be much, much higher? Nobody really knows. So with the uncertainty, it's created another complication for the administration in saying, we're solid here, we're going to force this on you. It just muddies the picture in a way that would not be true if this were a one-on-one battle.
Adding on to the muddied picture, some people are speculating that in the United States, as the government looks to retrench spending and start to really just get its balance sheet in order, China's expanding, and you're going to see the growth on the back end of that, and that you're already starting to see consumer activity picking back up. I know that, Leland, you track this really well in terms of anecdotal and non-government sources in terms of the economic activity. How much is the truth matching the narrative?
Well, you'll be shocked to hear the truth. The truth right now is not matching the narrative. Obviously, Beijing has a reason to look like they have fortified their economy for whatever is to come. And I think to some degree they have prepped the system for being able to do bigger fiscal, et cetera, if they need to do it down the line. But you look at our data and you see consumption. Consumption is very weak. Q1 wasn't a terrible quarter, but March was weak. Consumption was weak. Why were some of the things not worse off? Because you had a sort of rebound in property and you had a rebound in parts of industry. The consumption side of things do not look good. So nothing they're doing on that side is showing a real effect. So I don't think that they're not falling off a cliff. They're not in doomsday yet. But they're certainly not. The consumer's not coming to the rescue right now, and probably in China never will.
Leland, when can we expect a call between President Trump and Xi Jinping?
When the 10 years sends the right signal. I mean, look, to their credit, the administration came into this saying we're going to do what we want to do on tariffs, and we're not going to be dissuaded by short-term market movements. That's the equities market, and that's true. But the bond market has a much more restraining effect on everyone, and that includes the White House. And so I think what you're going to see is the bond market talking. If it continues to show displeasure, there's going to be increasing pressure on the administration to do something, not necessarily peel back in a massive way on this or that, but show that they have a game plan, and the game plan is not to abandon the U.S. dollar as reserve currency. So they have to move towards solidifying something that has hard themes that markets can trust, and to the extent that they need to give concessions with rates at 10% everywhere around the globe except China, that's one place that they may end up moving.
It feels like when you hear from the president or the press secretary, they're saying we're waiting for Xi to call. We're going to be very gracious when the Chinese reach out. Are you saying that if we see a higher 10-year yield, it's going to be the United States trying to get on the phone with Xi Jinping, not the other way around?
I think there's a lot more trying to get on the phone between the two of them than people are talking about. The narrative is always going to be not us, it was them. And that's going to be that's the story in China. It's going to be the story in the United States. But all they really need to do is put something on the table that looks like that there could be tariff concessions on the U.S. side and that there's a willingness to talk on the Chinese side. I'm not saying that they're there yet, but this is because the rates are arbitrary, as we discussed before. There's nothing that pushes the White House to keep the rates at 145 or 125 or 105 or 85 or any particular amount. That means that there is wiggle room. And I think if you have market pressures, particularly from the bond market, then you're going to have the two sides magically find reasons to come together.
Hey, Leland, good to hear from you. Leland Miller there of China Beigeberg. It is not a great cross-asset mix for taking risks this morning. Equities near session lows, down 1% on the S&P. Look elsewhere. Yields are higher, dollars weaker, gold to all-time highs. That's not a pretty read.
It's the Sell America trade continued, and it really raises this question: how much does this indicate some real money asset allocation shifts that have staying power versus a low liquidity day? It is a holiday in a number of places, exacerbating a move on the heels of what we heard on Friday from Kevin Hassett and speculation about the Fed's independence.
Bond yields pushing higher, dollar weaker, euro dollar 115.42. With an update on stories elsewhere, here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Pope Francis has died at the age of 88. He had been the spiritual leader of the world's nearly 1.5 billion Catholics since March of 2013. Francis hailed from Argentina, making him the first pope from the Americas, as well as the first Jesuit to hold the position. Elsewhere, Chicago Fed President Austin Goolsbee is warning against President Trump's efforts to curtail Fed independence. Goolsbee told CBS that the absence of central bank independence would lead to higher inflation rates, slower growth, and a worse jobs market. Tesla bull Dan Ives is warning the company is facing a, quote, code red moment before reporting earnings tomorrow. The Wedbush securities analyst said Elon Musk should focus on Tesla and step back from his Doge role as it has caused brand damage. Tesla is down over 40% year to date. And that's your brief. John.
Danny, thank you. More from Danny in the next hour. Up next on the program, questioning Fed credibility.
I strongly hope that we do not move ourselves into an environment where monetary independence is questioned, because that would undermine the credibility of the Fed.
It's been questioned this morning. Up next, Tom Tzitzouris of Strategas from New York City. You're watching Bloomberg TV. Returning after the long weekend with equities selling again. We're down by 1.3% on the S&P. We're down by 1.6% on the Nasdaq 100. In the bond market, the curve steeper. Yields down just a touch at the front end of the curve, higher at the long end of the curve. Look at this move on 30s, up by close to 10 basis points, 4.8950 on a 30-year bond yield. And with yields higher, what's the dollar doing? Dollar's weaker. Euro dollar 115.42, DXY negative by more than 1 full percentage point. Under surveillance this morning, questioning Fed credibility.
There's virtual unanimity among economists that monetary independence from political interference, that the Fed or any central bank be able to do the job that it needs to do, is really important. I strongly hope that we do not move ourselves into an environment where monetary independence is questioned, because that would undermine the credibility of the Fed.
So here's the latest this morning. The prospect of Fed Chair Jay Powell's removal dealing a fresh blow to U.S. assets, with the dollar hitting new lows for the year. Tom Tzitzouris of Strategas writing the tariff tantrum was caused by many forces, but we say with a high degree of confidence that it's not being driven by a permanent abandonment of the U.S. dollar and safe haven Treasury assets. Tom joins us now for more. Tom, good morning. Good to see you.
Oh, good morning.
What do you make of this move in the bond market today, particularly at the long end, the curve steepener that we're seeing? And do you think it's off the back of these concerns around Fed Chair Jay Powell's future and Federal Reserve independence?
Well, I think that's the immediate catalyst. But I think the bigger picture here is that there's really no buyer stepping in to stabilize this. There's always going to be some selling pressures, but this is a seasonal weak spot in the Treasury market where if there's any surge in selling activity, the buyer base does not stand by ready to buy. With that said, we have another catalyst in the news about the Fed's independence, so it doesn't help that that news came out in the last few days.
Certainly over the last month, we've been thinking more and more about the future of U.S. safe haven status. Yeah. Do you think it is under threat?
It is, to the extent that tariffs are going to shape the global consumer base and they're going to shape capital flows. That is a adjustment that's probably going to play out over a decade. A lot of it seems to be playing out over the past few days, few weeks. I think that that's a temporary adjustment right now. We're going to have to see how this really translates into less demand for dollar assets. And eventually the Treasury will adjust its borrowing to accommodate that as well. So this adjustment is being driven by other forces. It just so happens that in the process, we're beginning the movement away from the dollar, but it's never going to be a full abandonment of the dollar.
Okay, so there's a lot to unpack here. There's the idea that if President Trump gets what he wants, and that is less of a trade deficit, that naturally depresses some of the demand in the market for dollar-denominated assets. But on the flip side, you see the deficit maybe coming in the fiscal picture for the United States. So are you buying long end?
Well, we would be at these levels, yes. We think duration is attractive here because there's going to be collateral damage to the U.S. economy, and eventually there's going to be flight back into quality assets. And I still argue the U.S. Treasury is the highest quality creditor around the world. And with that said, we're in that temporary soft patch here where we've got tax payments have come out. There's no buyer stepping in ready to backstop the Treasury market. So it doesn't mean 10s aren't going to rise another 20 basis points. The buyer hasn't stepped up yet, but eventually the buyer will step up.
There's so many moving pieces here that everyone's heads are kind of spinning, and it's sort of this very difficult time to game out the structure of how this plays out. How much are you counting on this the fiscal deficit being reduced in order to get conviction to keep buying the long end of the yield curve, given the fact that so far what we're seeing is the projection for an increase of some $4 trillion over the next decade to the national deficit?
Well, I think that $4 trillion estimate doesn't take into consideration what will be $400 billion a year of additional tariff revenue. Likewise, you're not factoring in that there's going to be eventually net interest margin, should say net interest costs are going to be coming down as the curve does eventually flatten and the Fed eases more. So you will see some relief on the deficit, but that assumes that there's no additional tax cuts. If we just extend the Trump tax cuts without additional cuts, then we should expect to see the deficit coming down modestly, but still probably $1 trillion or more per year.
So your estimate that the long end of the U.S. yield curve, that long-dated treasuries is an attractive buy, is predicated on the idea that these tariffs stick at these levels and cause the U.S. to actually take in more revenue?
Stick at a level that is well above what we were a year ago, whether it's the initial announcement, April 2nd, or somewhere in between that and where we were a year ago. We're going to see tariffs sticking in place at some level that is going to bring in substantial amount of revenue. I think we estimated with the announcement on April 2nd, we were looking at $600 billion of tariff revenue in 2025, we'll say next 12 months. That is probably going to be scaled back more like a $400 billion. But we're still talking about a substantial tax increase, which, by the way, would be one of, if not the largest tax increase in American history.
So, Tom, you're basically talking about the fact that no country can negotiate below 10%. As a minimum baseline, there will be a 10% ring around the United States.
I think that's a very reasonable estimate of where we're going to be when all is said and done. And I think that's going to give us quite a substantial tariff revenue boost to the U.S. Treasury. With that said, that will shrink as each year passes. So there's going to be a question about long-term deficits, and this is why the administration has to be very careful. What additional tax cuts do they try to implement? Now, with that, if there are additional tax cuts on the marginal individual tax brackets, you should start to see more of that Treasury issuance being financed domestically, which is part of, I believe, the secondary goal here as well. We want to finance that internally because there's all sorts of benefits that come with that as well.
Just quickly, the dollar is down by almost 10% year to date. How much space does that give to the rest of the world to cut interest rates?
That's a good question. As much as they want, because you have to really acknowledge the fact that you're talking about central banks that generally are not independent. So they're going to be focused on protecting their export regimes at all cost.
Because that opened the door in one way for the ECB last week. And I just wonder if that's going to frustrate the president even more. That's where this started, on Thursday morning, going into that ECB rate decision.
He said they did it right. Why can't our Fed chair get off the pot and go for it? And there's this question here about how much a weaker dollar works against a Fed by importing inflation, the exact opposite of what people expected earlier this year.
Euro dollar 115.44. Tom, it's good to see you. Thank you, sir. Tom Tzitzouris there of Strategas, a bad company. Up next on the programme in the third hour of Bloomberg Surveillance, we'll catch up with Dawson of Newedge Wealth, Stefan Slowinski of BNP Paribas, Michael Gapen of Morgan Stanley, and Ed Al-Hussainy of Columbia Threadneedle. Your equity market is down on the S&P 500, negative by 1.3%.
The economy's in a pretty precarious place, but we're starting from a really strong base.
We need to be ready for some chaos along the way.
If we're in it for the long haul, then we have to accept the fact there will be implications to the economy.
We regard it as 45% chance of a recession in the US over this next year. And that's because of all this volatility and all this uncertainty.
This is a really highly uncertain time. This is an uncertain journey to an uncertain destination.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to all. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell, with equity futures near session lows on the S&P 500, negative by 1.25%. In the bond market, check this out. Yields at the front end just a little bit lower. The move at the long end gets your attention, up by 9 basis points, approaching 490. And that ugly mix of higher bond yields but a weaker dollar in today's session. Your dollar, a new low for 2025.
Yeah, basically it's the Sell America trade continued, and the extra firepower behind this is the discussion over the weekend that ramped up about whether President Trump would be willing to or is studying the removal of Fed Chair Jay Powell. Real question here about how much this is something that's realistic versus something that he's toying with to express displeasure, given the fact that, as you mentioned before, the ECB is cutting rates and you're seeing other places dealing with ongoing disinflation. Well, this Fed is a little bit more concerned about potential inflation from the tariffs.
We're used to hearing his displeasure. That's not new. There was a new word in a social media post on Thursday that got our attention, and it was termination. His termination can't come soon enough. So what did the president mean by that, termination? Did he mean wait for the term to expire in May 2026 or do something sooner? Kevin Hassett, the NEC director, asked about all of this. Are they open to doing something here? The president and his team will continue to study that. That phrase, that quote, shaking markets worldwide.
Absolutely. He left the door open and basically said it's a fluid situation. There are conversations, or at least they're studying a pathway to potentially oust the Fed chair. He was asked, quote, if firing Jay Powell is an option in a way that it wasn't before. Because Kevin Hassett has talked about this before and how he said in the past it would be damaging to fire the Fed chair. Now he's saying potentially there's a new legal pathway to do so, and we're not that they're doing it, but they're looking at the options to do it.
The timing of this conversation is important. It is only 2 weeks ago where we were sitting around this table, Lisa, and only talked about one thing, the loss of safe haven status for the US bond market. This is another reason to have that conversation. That question mark, it still lingers. Yields up at the long end by close to 10 basis points.
And I would argue, even taking away this question of will he or won't he fire Fed Chair Jay Powell, can he or can't he, there is a larger point here, which is policy uncertainty. The United States has had a safe haven type of status because of policy predictability, the slow-moving nature of legislation, and the fact that there has been this sort of steady expected predictability in the United States. You take that out, and the longer this goes on, the more you start to see that effect on GDP, on earnings, and that's the reason why people said, in particular, Stuart Kaiser, time is not your friend here. And that's what I think is the important message.
As that uncertainty persists, it's not a great mix this morning. Equities down, bond yields up, dollar weaker, gold at all-time highs. Coming up this hour, we'll catch up with Cameron Dawson of Newedge Wealth as threats to Fed independence weigh on markets. We'll speak to Stefan Slowinski of BNP Paribas, looking ahead to big tech earnings, and Mike Gapen of Morgan Stanley as uncertainty clouds the economic outlook. We begin this hour with stocks lower as the future of the Fed remains uncertain. Cameron Dawson of Newedge Wealth saying a lack of Fed independence is a, quote, bad scenario for the US economy and what we call a zoo steepener, both a bull steepener on the short end and a bear steepener on the long end. Cameron joins us now for more. Cameron, good to see you.
Good to see you.
Zoo steepener, I've never heard that before in my life. Where did that come from?
So the idea is that you get both a bull and a bear steepener. It's very much a welcome to the jungle kind of moment because we think it is a bad scenario for the U.S. economy. As you have a bull steeper on the front end, short end yields fall, that hurts cash interest income on money market accounts. Think about those record money market balances that have been generating big, huge cash interest for individuals. Then on the long end of the curve, if you get a bear steepener, the long end moving higher, you don't get the benefit to the mortgage market, you don't get a benefit to corporate finance. So the end result is that you get pinched on both sides with lower yields at the front end and higher yields at the back end.
Do you think this nervousness around Fed independence is a reason to step away from the long end?
It certainly seems that that's how the market is trading. Now, I would note that the 10-year Treasury yield is effectively exactly where it was pre-Liberation Day. So for all of this volatility where we had yields move much lower, then move much higher, we're right back where we started. So if we really do see a de-anchoring of the long end of the yield curve, that would be notable. But at this point, it's just a lot of volatility and a lot of sideways chop.
Given all of the volatility, where are the comforting mantras like "Don't fight the Fed" or watch the data and data dependency? What's your North Star, as we were talking about earlier in the show?
Yeah, look, it's really difficult. If this were a movie, we would say how to lose exceptionalism in less than 10 trading days, meaning that you have called into question these economic world orders that have been so powerful for U.S. companies and being able to benefit from falling interest rates, from the ability to benefit from rising margins over time. And so the end result is that we're all asking huge, major tectonic shift questions.
Well, okay, so then what do you do with that? I mean, this is sort of the big question, right? Can you follow that, or do you start saying you can't change the world in 10 days? There are going to be some checks and balances and things that will take time, and so you can't throw it away.
I think that diversification is your friend. And if you look at the ability to be able to have a diversified global equity portfolio, I think it's even more powerful today than it was over the last 15 years. You've been in a 15-year relative bear market for non-U.S. stocks. And so you're finally starting to ask the question of, are these non-U.S. companies having a better place and role in a portfolio simply because we're seeing these dynamics of potentially money moving out of the U.S. into the rest of the world?
What does this mean for the U.S. economy writ large, this zoo steepener?
We do think it weighs on growth, and we think that growth estimates are still too high. You're sitting at a level of GDP estimates for 2025 at 1.7%. That's down from 2.3%. That's down from 2024 and 2023 numbers, but it certainly is not to the point where you're pricing in some kind of recession. So we think that also translates to corporate earnings that are likely too high as well. You have 9% growth this year, 13% growth next year, still trading at 19.5 times. This market hasn't fully calibrated to a lower growth world.
Do you think that's because the market is still waiting on deals to come out of the White House?
100%. There's still a lot of optimism that this could just be a short-term bargaining tactic. But if you actually see these tariffs get applied, we think that growth estimates, again, are just far too high.
We hear so much of this. I saw it from Jonathan Krinsky of BTIG over the weekend. We still get the sense that many assume a tweet about tariffs can erase all the damage that has been done. When do you think we get the wake-up call? Because at the moment, the data is being flattered by a pull forward of purchases. We saw that in retail sales in the last week. When does the wake-up call come? Deeper into summer?
Yeah, we think it actually will take longer. So we do think that hard data is going to soften. Hard data is certainly being flattering by a lot of pull forward. Look at the Dallas activity index. It's having some of its best times since November. You've also seen big upticks in things like autos as well as imports. None of that will last. We think that that will eventually slow, but the challenge you have is that it's going to take time. And that means that the Fed is going to take time because the Fed has been very explicit. They're waiting for hard data to slow in a more meaningful way to take action, which just means that they will be late to the game this time around.
What does the wake-up call look like in equity markets?
We do think that you're in an environment where you can see short-term rallies because positioning has gotten so light. It's incredibly important to note Deutsche Bank consolidated positioning is in the 2nd percentile. So it doesn't get much worse than that. That allows you to lift in the short run, but you are in a downtrend. You have a death cross that happened last week. You have momentum that has faded, which means that you can have these rallies, but they likely roll over. And that will then result in people starting to finally move out of equities and potentially reduce equity positions, which adds to further volatility.
So lower, and potentially a lot lower. This really goes to the ultimate question, and it's kind of where we started, which is how much at that point, if you do see true economic weakening, do bonds attract that cash back?
I think eventually they do, but you have to see yields move higher to draw people back into this market before people see them as a safe haven trade, which just means that bonds don't play the same kind of volatility dampening role in portfolios that they used to. We think once you start seeing hard data weaken, that's when people will step into bonds, but it's one of those moments where it has to get worse before it gets better.
What's playing that role now? Is it just gold for everyone?
Yeah. It certainly seems that way. The one thing we'd note about gold is that it is technically overbought, and you have seen very aggressive inflows into gold, which suggests that you could see a breather, but the uptrend is very, very powerful.
Raises the question, what does diversification mean in 2025 versus years gone by? We hear the D word all the time, diversify, diversify. Into what and away from what? What does that mean now?
Yeah, so it means that you have to get really creative. At the end of last year, we said that we thought equities would be higher volatility and lower return. So we launched an uncorrelated strategy, which looked at everything from water rights to litigation finance to infrastructure, things that don't derive their return streams from traditional equity markets or what the Fed is doing. But again, it's creativity. It's not something that is typically in your 60-40 portfolio.
Cameron, appreciate your time. Cameron Dawson of Newedge Wealth with the so-called zoo steepener. Is that going to catch on? I think it might.
I think it's cool. It
feels like a zoo at the moment, doesn't it?
I think that we all can relate. It feels like we're welcome to the jungle, start singing.
A zoo, a jungle, on the edge of a circus. Bond yields are lower by a single basis point at the front end. On the long end, we're higher by 9 basis points. With an update on stories elsewhere this morning, here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. We start with the news out of the Vatican, which has announced the death of Pope Francis at the age of 88. He had been the spiritual leader of the world's nearly 1.5 billion Catholics since March of 2013. Francis was known as the People's Pope for advocating for the poor and those fleeing war and hunger. Elsewhere, Taiwan Semiconductors warned of challenges in keeping its AI chips from China. TSMC said its supply chain is structured in a way that gives it limited visibility with how customers use its products, meaning TSMC can't prevent third parties intent on circumventing sanctions. Elon Musk is making plans to visit India after speaking with Prime Minister Narendra Modi. The Tesla CEO had been due to visit a year ago, but postponed the trip at the last minute, citing issues at his auto company. Tesla has long wanted to enter India, but disagreements over import duties and local manufacturing commitments have stalled progress. And that's your brief, John.
Danny, thank you. More from Danny later on this hour. Up next on the programme, the morning calls, plus Stefan Slowinski of BNP Paribas with Mag 7 earnings on deck. That conversation just around the corner. If you are just joining us, equities near session lows, down by 1.25% on the S&P. Bond yields higher at the long end of the curve by 9 basis points, and a new low for the dollar against the euro. Euro dollar 115.43. Equities at the moment down by 1.2% on the S&P 500. The losses resume. We're down by 1.5 on the Nasdaq 100. This will get your attention. The move at the long end of the curve on a 30-year bond, yields higher by 9 basis points. Across the curve at the moment, we're down by about a basis point at the front end, but it's the move at the long end. A steepness starting to kick in. Now, Lisa, if the Federal Reserve chair got fired, this is the move you'd expect, but on steroids. So this is like the appetizer for what could happen in the future. Just directionally, this is what people would anticipate.
And just if you take it to its extreme, logically, it makes sense. The Fed would be motivated to cut rates on the short end and potentially allow inflation to run hotter over the long end. What I find interesting is you can make these theories and question whether the narrative has gotten ahead of the reality, but you are seeing the flows to back it up, with flows out of the U.S. Treasury assets and into, say, the long end of the Japanese yield curve. So you do see the start for that D word and trying to achieve it across portfolios.
The towel right now is in the FX market. Dollar weaker against everything in G10, against the euro, euro dollar 115.39. So that's a new high for the year on that currency pair. That currency pair at the moment up by 1.3% and a new low for the dollar for 2025. That's the price action. Let's get you some morning calls. First up, Roth Capital lowering its price target on Alphabet to 180, expecting slower revenue growth in the company's search business. That stock is down by 1.2%. Your second call from Wedbush maintaining its outperform rating on Tesla. The analyst Dan Ives warning of a code red situation of Elon Musk sticks with Doge. That stock is red this morning. It's down by 4%. And finally, Raymond James downgrading Amazon to outperform, citing earnings pressure due to an uneven macro environment. That name is down by close to 2% in the pre-market. Let's stick with tech. Mag 7 earnings kicking off this week. Tesla reporting results after the closing bell tomorrow, followed by Alphabet on Thursday. Stefan Slowinski of BNP Paribas Exane joins us now for more. Stefan, welcome to the programme, sir. I have heard it from a lot of people I know that they hardly use Google anymore and they spend much more time asking chatbots questions that give them the answers they're looking for. How much of that is going to sharpen the earnings of Alphabet?
Yeah, good morning, Jonathan. Thanks for having me. So, Google results coming out this week. I think there will be questions around the search business, how AI overviews, how AI search is impacting the time people spend searching, and the overall growth of the search business. So certainly that's going to be in focus. People expecting 9-10% growth there. But Google is diversifying. They now have 25% of revenues outside of advertising, in cloud, in subscriptions. So even if search slows to around 7% growth, we think they could still maintain double-digit growth over the course of the year on the revenue side.
Stefan, for a long time, a lot of people would come on the programme and make the pitch for the name, and they'd say there was these really, really strong secular tailwinds for the name in places like cloud, places like AI. Stefan, now I'm just worried about their exposure to the underlying economic cycle and what a slowdown in activity might mean for the name in the months and quarters to come. Where would you be focused on with that in mind?
Yeah, I think when you look at tech, it's tough in hardware right now because of the tariffs and the China situation. I think it's tough in digital advertising and internet for Meta and Google because of the more macro exposure, the more cyclical nature of the advertising business. You have exposure to China e-commerce, especially for Meta, where that's 11% of revenues, and that's likely to weaken quite a bit. You have exposure to Gen AI disruption. You have exposure to regulatory pressure, as we're seeing with the trial starting today for Google on the search antitrust front, and obviously for Meta now ongoing as well. And then again, you have political pressures around content moderation and free speech. So I think for investors, the digital advertising space, the internet space, has been quite an attractive place to be over the last couple of years, but that's getting quite difficult. One of the reasons we prefer software is they don't have a lot of those headwinds that the hardware and the internet companies have.
At the same time, I mean, it's true, Alphabet has been at the crosshairs of a lot of these sort of perfect storm of events. There's another question mark, though, in some of their earnings data, how much they're going to continue to spend on the data center build out, given that a lot of people are questioning whether there was sort of, I don't want to use the bubble word, but a bubble in AI spending and some of the promises that came with it.
Yeah, so on the CapEx side, recently the company did confirm that they're going to spend $75 billion this year. I think CapEx, of course, will be a focus for all of the earnings. I think the AI trade, the AI demand will be a focus. Our view is that much of the weakness we're seeing in tech stocks is macro-related because of the turbulence that we're seeing, but the AI demand is remaining quite robust. We heard Andy Jassy just a week or two ago when they published their shareholder letter talk about AI demand holding up. That said, Microsoft will be the one to watch here. That's the one that's been cutting a little bit on their infrastructure build out. We think they come out of this earnings season looking like the adult in the room, where they're still seeing very healthy demand on the AI front, but they're stepping back a bit on the CapEx side. They don't have to build out all of that infrastructure for OpenAI as OpenAI starts to do their model training elsewhere. So we think that maybe tilts the balance towards Microsoft this earnings season, where you still get that healthy AI demand, but you're getting a more prudent approach towards the AI spending.
So would you define Microsoft and Google as software companies at this moment, more akin to Netflix, or hardware companies based on the capital expenditures that they've been putting out there to try to back up some of their corporate cloud build out?
Well, that's the challenge because they kind of fit in between. And when you look at some traditional valuation metrics, whether it be cash flow metrics, obviously they're quite depressed right now because of the heavy upfront capital expenditures. But we look at what's their core competency. Their core competency for a Microsoft and for a Google is software development, and obviously managing that infrastructure that's required to deliver those services to billions of users.
Stefan, can we just finish on the legal challenges for the likes of Alphabet? What do you think the biggest challenge to the online search business right now is? Is it the Justice Department, or is it challenges in the actual marketplace coming from elsewhere?
I think it's market challenges. What was interesting on Thursday when you had the somewhat negative decision around the ad tech business, the stock closed down 1%. So in a way, we're kind of coming out the other side of the tunnel on two of the big challenges, one in search and one in ad tech. We obviously enter the remedy phase, but there's a bit of light at the end of the tunnel. I think where there's not light at the end of the tunnel is how is the search business affected by generative AI? What happens as we move towards AI assistants and AI agents? Google's very well positioned there overall. They've got incredible technologies from the semiconductors up into the large language models. But will they be able to maintain those cash flows and those market shares that they currently have in search? That's the question that continues to overhang on the stock.
Stefan, you said we're in the remedy phase. What is the remedy?
So for the search business, there's potentially them being forced to spin off Chrome. And then in the ad tech business, potentially could have to sell off either their ad server or ad exchange parts of their ad tech stack. So those are the discussions that they're entering into right now with the government.
Are you comfortable if that was the outcome?
It's uncertain, right? So we don't know what removing Chrome would do to the overall business. Obviously, it doesn't generate revenues directly, but it does generate a lot of data that Google can use for targeting advertising. I think that's more of the concern. I think on the ad tech side, this is a lower value add part of what they're doing. I think there's less concern around that, which is why we saw less of an impact on the shares on Thursday.
The DOJ says that a divestiture of Chrome would, quote, provide an opportunity for a new rival. Who would take that space?
Well, who would be allowed to buy Chrome, is another question. So, we don't know. A lot of uncertainty around that. But like I said before, that would prevent Google from capturing some data that it currently uses to power its ad targeting capabilities.
There's also not just issues here in the United States. You had Ursula von der Leyen today coming out and talking about no matter who the executive is, whether it's X, Meta, Apple, TikTok, they need to be aware that the bloc is ready to enforce in full the digital rule book. How challenging are these tech companies facing these issues in Europe as well?
Yeah, and that's all intertwined with some of the geopolitical pressures that we're seeing. So you have the Digital Markets Act in Europe, the Digital Services Act, and these big gatekeepers that are going to be held to account for how they're managing privacy and how they're managing cross-selling of their different businesses. This is also kind of getting folded into that tariff discussion with debates around the U.S. and European Union and whether or not the European Union will use this as a tool within those discussions and negotiations. Will they threaten to put more pressure on the big tech players, the advertising players, the big internet companies, or will they ease off if they feel like the U.S. government's going to kind of back those U.S. companies as part of those negotiations?
Hey, Stefan, I appreciate your take. As always, Stefan Slowinski there of BNP Paribas Exane. We've heard this argument a few times. The biggest threat to the search business is not the Justice Department, is ChatGPT. The biggest threat to the search business is not the EU Commission, it's Perplexity. It's these chatbots which people are increasingly leaning on and leaning away from the likes of Google.
Even Google is trying to outdo itself with a ChatGPT-like system. So when you ask a question, it comes up with the answer rather than a list of potential things to search. It goes to this question, does progress or evolution move quicker than the justice system, or at least the anti-trade system, or the sort of issue with the FTC? Honestly, it remains to be seen. Nonetheless, you can understand why people are getting a little skittish around some of these names. They're really at the crosshairs of so many different potential storms that are coming down the pike.
Give the market time and the market will take care of things. And that seems to be what's happening with the likes of Google, at least for the moment. If you are just joining us, equity futures at the moment on the S&P 500, negative by more than 1%. In the bond market, yields higher at the long end of the curve by something like 9 basis points so far this morning. What are the constraints around removing the Fed chair, Jay Powell? Luke Cower out on X this morning. Speak to a bond market strategist maybe and not a lawyer, because the bond market will provide that constraint pretty quickly.
And this goes back to what we've been talking about all morning, which is at a certain point, it has seemed in the past few months that the market is some sort of constraining force, at least on President Trump's actions. If you start to get a 10-year yield at 5%, does he start saying, all right, Fed Chair Powell, you seem okay to me?
The long bond in control, the 10-year up by 6 basis points, the 30-year up by 8. Up next, Michael Gapen of Morgan Stanley, and we'll catch up with Ed Al-Hussainy of Columbia Threadneedle. From New York, this is Bloomberg. Coming off a week of losses on the S&P, and the losses continue. We're down by 1% on the S&P, and the Nasdaq 100 negative by 1.4. The opening bell about 60 minutes away. With your morning movers, it's Danny Berger. Hey, Danny.
Hey, John. We're about to get into the thick of earnings season. About a third of companies as measured by market cap will report. That includes Tesla tomorrow, starting off on a negative note of its earnings week, down 3.8%. Got some negative news on the sell side. Barclays downgrading its price target. Also seeing Wedbush Dan Ives saying that it is a code red unless Elon Musk Musk turns his attention back to Tesla. Also adding insult to injury, Reuters reporting that their more affordable Model Y will be delayed, the launch of it, by at least 3 months. We also have some earnings to catch up from last week after the close on Thursday. Heading into the holiday weekend, we had a Netflix report of record profit. Those shares in the pre-market up nearly 1.8%. The CEO also saying when it comes to concerns about the consumer, about the economy, it's just not showing. They're not seeing it. Saying that in past recessions, entertainment and Netflix in particular has been resilient given they have the lower tiered subscription structure that will make them able to continue to get those dollars in. So those shares heading higher in the pre-market. Wrapping things up with the much awaited and much desired more lax regulation leading to M&A. Capital One getting the nod from regulators that it may indeed go ahead with its acquisition of Discover Financial. Those shares up 4.4%. John, the combination of the two will create the world's largest credit card issuer by loan volume.
Amazing. Danny, appreciate it. Thanks for the update. More from Danny later this hour. Let's turn to the economy. Here's a take on Wall Street from Michael Gapen of Morgan Stanley, writing, while the outlook remains clouded, incoming data suggests the economy is on relatively sound footing. A Fed that has its eyes on inflation will be reactive, not preemptive. Mike joins us now for more. Mike, good morning.
Good morning.
We'll get to that line on the Federal Reserve in just a moment.
Sure.
I want to talk about the economy. How much of the incoming data is just flattered by a front-loading of activity?
I think a lot of it is, right, which makes the Q1 data noisy and probably not representative of what's in front of us. So a lot of front running on consumption of autos, but a lot of imports, as we know. So the imports mechanically subtract from growth in the quarter. We now think we're entering, what I'll call the tariff zone, right? We should start to now see the data that will be reflective of these tariffs. And I think we did get a glimpse of it with the Philly Fed PMI last week, where new orders plunged in April. It's an April reading. And it didn't just move to levels that were consistent with a start of a recession. It moved to levels consistent with the bottom of a recession. So the economy is on solid footing. But I think the question is, does that even matter with tariff levels this high between the U.S. and China? And are you risking a sudden stop in trade volumes that will show up very forcefully in the April and May data? Philly Fed's just a survey. It's 1 month. It's one region. But it had the overtones of a very strong tariff effect.
Given all of that you just said, what does data dependency mean for the Fed?
Well, data dependency for them right now is, and Powell said it pretty clearly, we expect to kind of be offsides on both sides of our mandate, right? We expect deterioration on inflation. We expect deterioration in the labor market. So data dependence at this point means we probably stay right where we are, because we want to, in theory, hike on one hand and cut on the other. So the right thing to do is probably do nothing.
And you think doing nothing means that they're going to be late?
Yes, because the inflation impulse comes first, and so that kicks them to the sideline. So if tariffs do slow down the economy like we and others expect, and ultimately the Fed will react to the weaker activity data, but it needs to see that data, right? And which means by the time they show up, they're likely to be late. That's not necessarily the wrong policy choice, meaning it's not that they're making a mistake, it's just they're forced into that because maybe activity doesn't weaken as much. Maybe immigration restrictions mean the labor market stays tight, and therefore the right thing to do is to keep policy where it is to combat an inflation problem. So there's enough.
What happens next? This happens. Mr. Late is always late. Can't wait for his termination. What does that mean for the Federal Reserve?
Well, it puts them in a tough spot. I mean, it means in my view, it overlays on a number of things that point to slower growth and firmer inflation outlooks, right? So it's immigration, it's tariffs, it's concerns about political independence of the Fed, and that all moves in the direction of slower growth, higher inflation. From the Fed's perspective, what it means is I think they just need to be laser focused on what they're doing and defend why they're doing what they're doing.
I want to lean on the operational aspect of this.
Yep.
How they'll conduct things, how the operation might change. Do people start auditioning for the spare seat? Because there are some people making that accusation about one governor on the board, that maybe that governor is just auditioning to take over from Chairman Powell in 12 months from now. How will this play out?
Well, it does appear that they will be interviewing for Powell replacements later this year. So it plays out in a way where you wonder, is there a chair and is there a shadow chair? So that just, again, means more noise in the market and more confusion about the direction of policy.
This is a two-sided risk right now. There's the risk of the Fed losing independence. There's the risk of these tariffs really impeding growth. There's a risk of protracted inflation. And there's also a risk of tariffs getting negotiated much lower.
Right.
And some of the strength that we saw pulled forward continue through the rest of the year, since this still is a pretty resilient economy. How long does this economy have before the uncertainty starts to really, really undermine some of that strength?
Well, super hard to have the exact answer to that. I'd say probably a few months, 2 to 3 months. I think we can probably sit in this intermediate stage where we're hoping tariffs get negotiated down. Some of the kind of the grip that would have on trade volumes can dissipate. So I think the corporate sector can sit in a period of caution for a few months, right? So delay. But what we're also hearing, contracts are getting canceled on the import side as well as the export side. So we've got this tension between what we think is a negotiation process which will bring tariffs down, certainly with kind of non-China trading partners. But on the other side, though, we're seeing that trade is just not economically viable at these tariffs, and therefore things are getting shut down. So there's a tension between both of those. How long can that last before the economy as a whole turns? Hard to say. But again, I think we can probably do this for a few months, but the clock is ticking.
Lisa's rebranding as a cautious optimist around the trade story. Is that what we're doing here? Cautiously optimistic.
How about this? Contrarian, because everyone's talking about the downside risk.
Right. We can go with that.
And I think right now there's also an upside risk. And you have two sides of this coin. On one hand, you've got the upside risk of growth actually hanging in there. And then the Fed doesn't need to cut rates because everything is just fine. And then you have the flip side where in a couple of months' time, you have a real deceleration. And then Andrew Hollenhorst coming out and saying that the risks are skewed toward more cuts. There you go with that sort of estimate, regardless of who is the Fed chair. So this is sort of the two-sided risk that I'm looking at. And it's like, which one are we underweighting here?
Credit to you, because if the risk cuts both ways, it's another reason for the Federal Reserve to do nothing. Now, Andrew, to your point, believes the Federal Reserve cuts rates 125 basis points this year.
Right.
What do you think this Fed does?
None.
So he's at 125 and you're at 0. Can you explain the difference?
Well, I don't know his growth outlook and recession
Andrew
call.
thinks ultimately this starts to hurt the labour market.
Okay.
And that once it begins to hurt the labour market, the Federal Reserve will put more weight on that side of the mandate and start cutting interest rates.
So that's fair, but given where inflation is likely to be, so what's going to drive that weakness will be tariff-induced inflation. If inflation's moving to 3.5% to 4%, the unemployment rate has to rise a lot to put the mandate in balance, right? Risks to both sides of the mandate.
By a lot, you mean something in the fives?
Yes. If you probably have to get over 5 and moving in a direction that they think is going to keep moving higher. So could you get that? Yes, I think you can get that. But I would say I'm maybe more open to your side of the argument here, if I can do that.
You're allowed.
And say that the cautious optimism side is this is largely self-induced. This is not an exogenous shock to the economy that we can't get out of the way of. So if the argument is we've done A, B, and C, and that's created bad outcomes, then maybe there's a way to dial some of that back to keep the economy in, let's call it better balance that doesn't require an obvious reaction from the Fed.
And to Lisa's point, this is why the range of outcomes is so wide. You've
That's
got
right.
Mike Gapen at 0 and Andrew Hollenhorst over at Citi at 125 basis points of cuts for this year.
Yeah, you're trying to game out where we're coming from because people disagree on what the data says, as well as where we're going. And you can read the tweets and the truths and try to figure it out yourself. But basically, everyone's spinning their wheels against the unknown, which is the difficulty right now in markets.
Well, and it's about a coin toss, right? So it's why the market can price in roughly 3 to 4 cuts and move back and forth, because it's basically half where I'm sitting and half where others are. So it's not that path that the market is putting in is reflecting the virtual 50-50 on these two outcomes.
Each month feels like a quarter, doesn't it, at the moment? Or maybe a year. Mike Gapen and Morgan Stanley, appreciate it. Just closing out the first month of the second quarter, right?
Oh,
I think,
God.
yeah. Just closing out April. April 21. Just got to double check all the time. Equity futures on the S&P, negative by 1 full percentage point. The president and his threats to Fed Chair Jay Powell's future, shaking up markets worldwide and keeping investors on edge. Mike McKee, our economics and policy correspondent, joins us now for more. Good morning, Mike.
Good morning, John. Well, we've talked a lot about what the markets might do if Jay Powell were fired. How would it work out? What would the president try to do? The Federal Reserve Act says, of course, and you've heard this a number of times, that the Fed governors can't be fired except for cause. The Federal Reserve Act says each member holds a term of office for 14 years unless sooner removed for cause by the president. Now, what does for cause mean? That's going to be the key here. It's undefined. Historically, courts have construed it as misconduct, incompetence, or incapacity, but it's never been litigated in terms of the Fed. The Supreme Court now considering those two cases with the National Labor Relations Board and the Merit Systems Protection Board about whether the leaders of those could be fired. There are some similarities, and if that is the case, and we don't know when it's going to actually go before the court, then maybe there's grounds for the president to be able to try to move. If not, then here's the timeline. As Board of Governor chair, Jay Powell's term expires in May of 2026. Getting interviews going this fall, as we've been told, is the likely process. I mean, it's what you would expect. As a Fed governor, though, Jay Powell can stay on till January of 2028. Would he do that? Michael Barr decided to stay on after he resigned as a vice chair for supervision. And then as FOMC chair, the policy-making committee, that's every year. They pick a new chairman, and they always, by tradition, pick the chairman of the Fed. If the president puts somebody else in, then the members of the Open Market Committee could still pick Jay Powell. You don't have to be on the Fed to be chairman of the Open Market Committee. So there's a lot of moving parts here, but the question is, do they all come together enough that the president could get rid of Jay Powell without setting off a market tsunami?
Throw your name into the hat, Mike. See what happens. Mike McKee, thank you, sir. An extra wrinkle there that I hadn't thought of. Joining us around the table, Ed Al-Hussainy there of Columbia Threadneedle. Ed, good to see you, sir. This move in the bond market. Yields up at the long end by 9 basis points. Are you willing to sell this fear and buy this bond market this morning? Do you see good reason to do that?
Well, it depends where. I think at the very long end of the curve, we are starting to price in a little bit more fiscal premium as well. I don't want to lose sight of the fact that obviously tariffs taking up a lot of the oxygen, but we do have significant fiscal legislation moving in the background, and that move is accelerating. I think we're starting to see some of that fiscal premium in the long end. Where I want to concentrate my buying is really kind of in the 5 to 10 year part of the curve. There's value there. I think treasuries continue to offer good ballast versus equity and credit risk.
So you think that they preserve their safe haven status at a time when many people believe the move we're seeing in markets really undermines that? What gives you that confidence?
Yeah, I mean, there are a couple of things. One, there just isn't a great alternative to treasuries in terms of a safe haven asset out there. Not yet, anyway. European assets, Asian assets are just not mature enough. And second, the Fed and the Treasury provide a balance sheet backstop to treasuries that's really unrivaled in markets. And so those two things combine, to me, combined in such a way that when there is a serious period of stress, we haven't had that yet. We've seen markets bend, but not quite break yet. Those balance sheets are going to be critical in backstopping the Treasury market.
So everyone says that this Treasury market is the deepest, most liquid, most mature market out there, and it's trading like a penny stock. Doesn't that give you pause, or at least make you think that you got to at least charge a higher premium to own this debt?
Sure. And look, where would treasuries be today if we had continued on the path we set last year? Inflation's continued to come down. Financial conditions have tightened materially this year. The hypothetical today would be a treasury with a 3 handle. So we have that higher term premium today than we would have otherwise. We have that uncertainty around the inflation premium in the long end. The question is it adequate, right? And the market's still feeling it out.
Ed, would it still maintain a safe haven status if the president fires the Fed chair?
That's really tricky. Again, I think I lean towards yes, because there isn't an alternative at this stage. Europe has a very fragmented fiscal market. China does not give foreigners access to their debt capital markets the way the West does. And so there just isn't an alternative yet. But again, if there is a disruption to the Fed's independence, we are on a slippery slope to, I think, a bad outcome.
I assume you mean in the long term, but in the near term, yields would still climb. What would happen that day that the president comes out and says the Fed chair is gone? What do you think would happen in the bond market? You think we'd rally or sell off aggressively? Because what we hear is that at the long end, people would shy away from that for quite a while. What would your take be?
Well, they're shying away from it right now.
10 basis points is not the Fed chair just got fired trade.
Absolutely. So, well, I think the question is we don't quite know. There's a little bit of a market functioning dynamic that's in play here in terms of liquidity. I think what's very likely is if it is a surprise announcement, we will have the Fed balance sheet and the Treasury balance sheet put into play to backstop the market. And I think that's really important. We can't really have price discovery on an announcement like that. The market is going to be pretty wild, and that's going to be an understatement. But the fact that we have those backstops, I think, is really critical.
It would raise the question whether we should be applying an EM framework to a developed market economy. Are you pushing back against that view?
Not yet. Not yet. Look, I think the EM framework here is both bonds, risk assets, and the currency weakening simultaneously. And I think particularly when it comes to the currency, there are compelling reasons for the dollar to be much weaker. I think in my mind, if I go back to the early 2000s, that's a very similar dynamic that we have today. The dollar weakened for about 6 years, from 2002 all the way into the global financial crisis. We did not lose our safe haven status then, but the dollar started that decade at overvalued levels. Similarly, the dollar ended last year quite overvalued. So there are definitely compelling reasons for the dollar to weaken. There are compelling reasons for equities to be re-rated lower and credit spreads to be wider. That does not mean the treasuries lose their safe haven asset.
At the same time, it does raise a question about inflation, especially if this is a question of trade. And the dollar is weakening means that on the margins, we're importing inflation. We have to spend more to buy goods from overseas. Does that also pressure yields higher in a way that it hasn't traditionally?
Not yet, in the sense that those prices are also destroying demand. And I think the negative demand shock at this stage, the tightening of financial conditions, the loss of purchasing power is going to outweigh that inflationary impulse. And you see that being picked up in the TIPS market. The break-evens today are at year-to-date lows. So that inflation premium, yes, it's there, but it hasn't really spiked. What we're really seeing in my mind is that term premium, is that uncertainty premium around what will the Fed do when its mandate is in conflict.
What kind of divergence are you anticipating between central banks worldwide? We saw the ECB reduce interest rates last week, and it felt like that was just the beginning of something much bigger, because the biggest threat right now to European price stability are Chinese exports. And I just wonder what they can do about that. Are they just going to be on a rate-cutting cycle from here, deeper, 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 and does the rest of the world go with them?
I think it's becoming more likely, as we see global demand take a hit, that we see a simultaneous backstop, both in terms of fiscal policy, fiscal stimulus ramping up, and monetary policy, again, providing some both liquidity and demand back into the system. The ECB is there. Emerging market central banks are there. The Bank of Japan has much more limited room to cut rates, to hike rates in this environment. And obviously China is providing massive stimulus to get out of their deflationary dynamic. The only missing piece here is the Fed. Once the Fed starts to move, that move tends to accelerate.
Yeah, everyone, ex the Fed. That weaker dollar is giving other people a lot of space to reduce interest rates if they need to.
And it's at the behest of the Fed, not because of the Fed. And it raises this issue, and you alluded to it, John. How far can that divergence continue? Can you get U.S. 10-year Treasury yields up near 5% with some of the concerns around fiscal as well as inflation, while the rest of the world is cutting rates and seeing their yields go way down? This is going to be a really interesting moment.
It's an interesting moment, that's for sure. 438 right now on 10s. Yields are higher by 5 or 6 basis points. Ed, sensible and well framed as always. Appreciate your time. Thank you, sir.
Thank you.
Ed Al-Hussainy there of Columbia Threadneedle with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. We start with the news out of the Vatican, which announced the death of Pope Francis at the age of 88. He assumed the papacy in 2013 and became known as the People's Pope for advocating for the poor and those fleeing war and hunger. On Sunday, he had met with U.S. Vice President J.D. Vance. Elsewhere, Boeing has begun returning 737 MAX jets to the U.S. That were refused by Chinese airline customers. According to data from Flight Radar 24, a jet intended for delivery at Xiamen Air flew back to Guam after arriving in China last month. Bloomberg reported last week that China told state-run airlines to stop taking deliveries of Boeing jets. U.S. Defense Secretary Pete Hegseth is said to have shared confidential military details in a chat on third-party app Signal for a second time. The New York Times reporting that Hegseth created and sent information to a group, which included his wife, brother, and personal lawyer, about strikes in Yemen in March. And that's your brief. John.
Hey, Danny, busy one. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the week ahead. Live from New York City, this is Bloomberg. Equity futures softer here. We're down by 1% on the S&P, negative by 1.4 on the Nasdaq 100. In the bond market, this curve is steeper. Yields are climbing at the long end by 7 basis points. And once again, the dollar is weaker. New lows for the year against the euro. Euro-dollar 115.39. That currency pair firmer by 1.3%. As we count you down to the opening bell, your trading diary through the week looks like this. Today, the IMF meeting's kicking off in Washington. Tomorrow, earnings season ramping up with results from Tesla. Wednesday, Boeing reports, and we'll get some PMI data. Thursday, durable goods and another round of jobless claims, plus earnings from Alphabet. And on Friday, the final read of UMich consumer sentiment. And sentiment right now is not great. Sentiment not great in this market either. Let's bring in Tyler Kendall for more from the White House. Tyler, welcome back to the programme. The jitters, let's say, about the future of Fed Chair Jay Powell starting to breathe some life in some ugly trades in financial markets. What's the response from the White House after the weekend?
Yeah, hey, John. Well, Kevin Hassett was the one that first really put this on the radar, saying that the White House was indeed looking closely into any potential legal pathways here to remove Jerome Powell. And President Trump doesn't seem to be letting up on any of his criticism as he ties this so closely to his tariff plans. Now, we have been talking about how, in theory, Jerome Powell would be protected under the Federal Reserve Act of 1913, but it is important to note the broader backdrop that this is happening against in Washington, which is concerns about the future of independent federal regulators here. We've been talking a lot about the Supreme Court case related to the National Labor Relations Board, but I also point you to how last month 2 FTC commissioners were also fired and are contesting their firings in court as well. John, I actually just got off the phone with one legal expert who told me that it is by no means certain, but it is a possibility that no matter how these courts end up ruling on these independent regulators being fired, there is always the potential that there could be a carve-out there for the Federal Reserve and its decisions related to monetary policy. So still just so much uncertainty here as we look ahead into how this White House is going to end up trying to either pursue this path or keep Powell on.
Tyler, appreciate it. Tyler Kendall from the White House, thank you. Lisa, yields are higher, the dollar's weaker. A taste of things to come?
Well, maybe this is a sort of protest moment from the bond market. Hey, listen to us. Pay attention to us. And maybe that'll be enough.
Is that what bond market people do?
Evidently.
Bit needy.
Queasy.
Self-centered.
Oh, yeah, Mr. Market.
Yields up by 8 basis points at the long end. Coming up tomorrow, Krishna Gua of Evercore, Mike Parle of BlackRock, Tom Kennedy of JP Morgan, Michael Kushner of Morgan Stanley. From New York, this was Bloomberg Surveillance.